be that trust. Third and finally, the supply chains, the domestic supply chains. Yesterday, the current president, President Trump, saying that they are continuing to work on the supply chains to make sure that the rollout of the vaccine is both effective, and the incoming administration is obviously going to have a lot of work in the execution of that as well. But you cannot look, I mean, even in Roosevelt years, you cannot look at the current state of affairs and argue in any which way that the rollout of the vaccine, that will be the dominant force in President-elect Joe Biden's first 100 days in office. It will spur the talks for another round of stimulus in the first quarter of next year. It will urge the education community to try to get more funding in terms of the rollout of this. And it will really set the tone for how effective the executive branch across the board, from geopolitics to domestic, can set up a 4-year term for President-elect Joe Biden.
Kevin Cerulli, thank you so much. Our chief Washington correspondent this morning. Futures up 7, Dow futures up 81 as well. On the political front, this is an interesting conversation. David Weston with Jay Clayton. He's exiting as SEC chairman. This will be timely given the state of global and American Wall Street. Stay with us. This is Bloomberg.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Surveillance. Good morning, everyone. Tom Keene in New York, Francine Lacroix in London. Lots of distractions, Brexit, dinner in Brussels. We've got what Kevin Cerulli was just talking about. And then there's the markets and where you are and what you've missed. Gabriela Santos is at JP Morgan. She's Senior Vice President, What You Missed in 2020, and we're thrilled she joins us this morning. Gabriela, a year ago and 2 years ago, you said one day international stocks will move. With a vengeance, they have moved. Let's begin with the why. Why did international stocks light on fire this year?
Yeah, we've had a very good year for international stocks, specifically a very good November, where international outperformed U.S. markets by 300 basis points. And I think you have a confluence of factors. First, international, given its decade of underperformance has much more favorable starting points than U.S. markets do. And here I'm thinking of valuations as well as the currency. We also have a very good aligning of factors for international, which is the beginning of a brand new economic cycle. That tends to be very good for cyclical sectors, which have a much higher representation in international markets than they do in a very defensive market like the U.S. And we've also had a big decrease in uncertainty, so it helps risk appetite as well.
Gabriela, you know I go all logarithms on you. I've got to do that to keep up with you. And the answer is we reminisce about the slope of international markets in the 1990s. And then there was some miserableness for X number of years. And we've got a little bit of a reaffirmation of that constructive slope. Is it just about the U.S. dollar? Is that all this analysis is?
Well, the U.S. dollar is really a symbol of other things that are happening. So to me, the dollar speaks a lot to what's happening, for example, with growth outside of the U.S. relative to the U.S. And really the big issue for the past decade or the past cycle was the fact that the U.S. economy went through the global financial crisis and it kept on chugging forward. Meanwhile, around the world, regions had to deal with additional crises, the sovereign debt crisis hitting Europe, as well as the commodity bubble burst hitting emerging markets. So you had such a big disparity in growth and in interest rates as well overseas relative to the U.S. I think the really important thing to keep in mind is we're starting a brand new economic cycle right now. And we do think that we're starting on a much more even playing field, the U.S. versus other regions. So this is really the kind of environment where the dollar can strengthen and local international markets can do well.
Gabriela, is there anything in bubble territory? Like, if you look at the real economy and where markets are, does the real economy just catch up? So fundamentals are strong, they just need to get a little bit stronger? Or is there a real mismatch in certain parts of the markets?
Well, we've had such an interesting year. The first part of the market recovery from late March to late October was really all about that virtual world, so very separated from really what's happening in the real economy. It was really November where we started to get that expectation of a catch-up in the real economy. But it's really only the beginning. We still have very depressed cyclical sectors here in the US and around the world. But it is important for the real economy to catch up next year. And we do expect that it will, with the broader distribution of the vaccines and economic momentum building and building as the year progresses.
Okay, guys, I'm placing a new order to sell short euro. Price I'm looking sell at 121.269. Okay, 129.21, sorry, 269 right here. So let's wait if we'll get lucky and execute it for this order.
Gabriela, how long will it take for the economy to catch up to the trend we should have been on had we not had the pandemic? And what does that mean for stocks?
So regionally, there's some very big differences. For example, China has basically already caught up to where it would have been. So North Asia, China specifically, very much ahead of the pack. When it comes to the United States, in terms of catching up to trend, we think it'll take us to 2022, Europe a little bit after the US. And then when we think about other emerging market regions outside of North Asia, then we're thinking much more about 2023 and beyond. But I think for markets, the fact that we're starting that catch-up process is very much welcome, and that is why we continue to expect cyclical sectors and regions to outperform, at least for the first half of next year.
Well, you mentioned quality. What about big tech? I mean, Credit Suisse has been real direct. They do not see the end of quality tech. What's your JP Morgan call, JP Morgan Asset Management, on what has worked so well over the last 24 months?
Yeah, so I think the technology theme is really, of course, still a theme for the next decade. And really, I think what we're speaking to is much more a broadening of the tech theme in 2021, because remember, before November, it was really very concentrated on the top 5 or top 10 stocks. It wasn't really broader than that, and we're really thinking about a broadening of the tech theme. To me, an interesting statistic is that from late March to late October, the top 5 stocks returned 39%. The rest of the market was down -5%. That speaks to not just the virtual economy theme, but a very concentrated version of that.
Within all the thinking of J.P. Morgan, I mentioned Joyce Chang in your platform this morning earlier, Gabriella. Okay, so what's changed? Is the belief in not those 5 stocks, but the belief in the new technology out a decade, that hasn't gone away, has it?
Absolutely not. And I think the pandemic is just a taste of how we're really incorporating technology in every aspect of our lives, in every sector of the economy, and how these are really the industries of the future. And here it's so broad. It's not just social media, it's not just software, but it's also cybersecurity, digital payments. It's a very, very broad theme for the next decade. And to get access to that, of course, the US market has a lot of opportunity for these technology companies, but so does emerging markets. And let's not forget that there is a tremendous amount of technological innovation happening in China, in Korea, and in Taiwan.
Gabriel Santos, thank you for the briefing with J.P. Morgan Asset Management this morning. Much more coming up. Futures up 7. These are all record levels. Dow futures up 78, 30,248 on the Dow. Stacey Cunningham knows this. The New York Stock Exchange president in the 10 o'clock hour. This is Bloomberg. Good morning.
retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contributions.
I have to remove the order to sell short. It's moved too fast. So let's remove it. Let's see what's happened with euro.
You may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
When you call somebody, any head of state in the world, how hard is it for you to get anybody on the phone? I assume not too hard.
I would say it's not too hard, but sometimes it takes a week.
sort of technology landscape gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. Japan's SoftBank Group is debating a new strategy to go private. Bloomberg's learned that the plan calls for gradually buying back outstanding shares until founder Masayoshi Son has a big enough stake. Then he could squeeze out the remaining investors. SoftBank isn't commenting. Elon Musk is tired of being taken for granted, so he's moving from California to Texas. The billionaire co-founder of Tesla told the Wall Street Journal that California has become complacent with its status as an economic giant and is taking too much for granted. Tesla is headquartered in Northern California, but Musk is building a factory in Austin, Texas. For the second time this week, Uber is getting rid of a side project as it tries to turn a profit. The ride-hailing company is selling off its flying taxi division to Joby Aviation. Plus, it's agreed to boost its stake in the startup. Uber Elevate had imagined a future where air taxis shuttle people above traffic-jammed highways. Earlier this week, Uber sold off its self-driving car unit. And that is your latest Bloomberg Business Flash. Tom.
Ritika, thanks so much. On the data here, we have an elevation still to these record markets. Futures up 7. Dow futures up 81. I really want to make note the VIX didn't move yesterday with a lift all that much. 20.54. Maybe we see a 19 level on VIX today. Sustained. That would be a big deal. Oil not quite to 50 on Brent crude. 48.92. And on currency elevation, Mexican peso stronger. Francine?
Tom, global equity is definitely energized by the White House's surprise re-entry. Energized. We're energized, Tom. Re-energized because of the surprise re-entry into pandemic relief talks with, this $960 billion figure or proposal floated around. I'm also looking at pound advancing as Boris Johnson is heading to Brussels to save these talks. It'll be a fun meeting to watch, actually. So he's having dinner face-to-face with the European Commission President Ursula von der Leyen. I think for the moment, pound is kind of trading sideways. If you look at treasuries, they're slipping the dollar as well. Coming up, next, we track COVID-19 with Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine. But Tom, it's really the time to spin it forward to 2021. We'll look at vaccines in 2021, what it means for the U.S., and of course, what the holiday season could also mean for hospitalizations and treatments. This is Bloomberg.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're very hopeful that the FDA will authorize the Pfizer vaccine within days. We've got to get it moving. And Moderna vaccine almost immediately thereafter.
In COVID programs, predominantly, the vast majority will be through the vaccine. We'll invest around $2 billion.
We are in the middle of phase 3, and even towards the end, we are running a study. We might have results sooner than expected, but we target for results in the month of January.
You have to remember that even in the UK, anywhere, it's going to be priority groups that get vaccinated first. So it's going to take some time for the general public.
It's amazing to see the vaccine coming out. It's amazing to see this tremendous shot in the arm for the entire nation, but we can't afford to relax now.
What a week it's been. World leaders and executives are discussing coronavirus vaccine rollout, and it was certainly a big week here in the UK, with the first vaccine being, that shot actually being administered yesterday. Now, joining us today is Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine. Lauren, good morning. And what will the conversation be in early 2021 about the vaccine? Will we focus on how many people want it, or will we just have much more vaccines available in many more countries?
I think it's going to be a combination. I mean, I think making sure that people want it, that they're willing to take it, that they know it's safe, that they understand the differences between the types of vaccines that'll start to become available in 2021. Vaccine is definitely going to be the topic of conversation for a long time to come. The other thing I think we'll focus on is continuing out these studies to look at people who are getting vaccines, making sure we have a good sense of how the immunity is working, what protection looks like, how it's lasting, so that we can start to plan for whether or not we'll see continued surges and how we'll roll out vaccine broadly across the globe as we start to see those data roll in.
Lauren, how should we look at countries that don't have the means that a lot of the Western world have? How are they going to fund the vaccine?
Yeah, I think there's a lot of work being done in this space. So the COVAX facility is one area where there's a lot of focus on how vaccine will be distributed to low resource settings. You know, we are seeing a lot of the higher resource countries buying up vaccine and getting ready with plans to distribute, shipping vaccine out already, with plans to roll it out in their own countries. And so a key focus of 2021 has to be making sure that we have a plan to get these vaccines, whether it's focus on cold chain storage, vaccination behaviors, trust, all of these things have to go into making sure that we reach every corner of the globe and get vaccine there.
Lauren, so I want to stop the show, and you've been so beneficial to us over back to April and even back to March about this conference that you're having at the Bloomberg School of Public Health at Johns Hopkins University. The backdrop of this, folks, is moments ago, Jacob Kierkegaard of the Peterson Institute noted that in Stockholm, Sweden, ICU beds are at 95% plus. Lauren, the urgency right now as you bring together world leaders and American leaders on this is science comes first. What will be the difference in a Biden administration as we reaffirm the science of the Johns Hopkins University?
Yeah, absolutely. I mean, I think we're seeing that return already with some of his cabinet picks and this focus on science as the backbone of all of our decision making. We're seeing similar ICU rates. I think I saw 15% across the country as recently as yesterday is what is left of our capacity. And that just can't continue. We can't take care of patients if we continue to make decisions that leave our hospitals in this gap, in this lurch. And the people who suffer the most are the patients, and the other people that suffer the most are the people who are trying to take care of them. You can't maintain that pace when you don't have the capacity to put patients in bed. And so I think the hope is that with these cabinet picks, with the changes in policies that we're hoping to see from the Biden administration, that the focus will be on taking everything we've learned this year and synthesizing it and building a national and global strategy that we can apply across the United States, you know, that we can really bring back the science into the everyday decision-making that's happening in Washington.
Lauren Sauer, Greg Valliere leads his morning note with the phrase, denying the virus. You and I at gunpoint had to read The Plague of Albert Camus of 1946. We're reliving it right now. There are the deniers out there. What is your message to them as we try to reaffirm science?
I think the key is that the virus doesn't care if you believe it's real or not. It will be there, and the measures are low impact, right? So wearing a mask is relatively low impact, and social distancing is hard. Physical distancing is hard. Working from home is hard. You know, all of these elements go into protecting yourself against the virus. So whether you believe it or not, if you choose not to take those measures, it will be there waiting for you. And the science, it's just facts. You know, the science is not political. The science is really focused on how we can protect everyone, particularly our most vulnerable populations. And oftentimes the people who choose not to take up these measures don't seem to understand that they're choosing to not take these measures, and that impact goes far beyond themselves. It impacts our entire country.
Lauren, how much more? I mean, we had a story on the Bloomberg, terminal saying that the number of researches and actually copies of books that are anti-vaccines in general, not only COVID-19, but just in general, has risen exponentially. How do scientists actually counter that?
I think there's a couple of things that need to happen, and already are happening. It's starting the conversation with the person or the group of people and see where they're coming from. So finding common ground where the conversation can be initiated. And it doesn't always work, but oftentimes that's the place to start. So where can we come together and agree on facts? And then where do we go from there? The other, I think, key is involving people who you're trying to work with to implement measures, to convince that the science is real and that the virus is real. Involve them in the conversation, involve them in the planning strategies. And that's not always easy to do from the ground up, but the more people with disparate viewpoints, the more people that come from different backgrounds that are involved in these conversations around planning and implementing evidence-based and science-based practices into our response, the better and more comprehensive that response will be, and the more uptake we'll have.
All right, thank you so much, Lauren Sauer there from Johns Hopkins. And of course, as COVID-19 rates continue to surge, Bloomberg's American Health Summit, Tom was just talking about that, brings together experts and leaders, including National Institute of Allergy and Infectious Diseases Director Anthony Fauci, Michigan Governor Gretchen Whitmer, co-chair and President-elect Biden's COVID-19 task force, David Kessler, and Robin Hood Chief Executive Wes Moore to discuss how to transform the nation's public health system. You can watch that at Bloomberg.com and on the Bloomberg terminal. It starts at 2:30 p.m. in London, 9:30 a.m. in New York. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. Treasury Secretary Steven Mnuchin is trying to break the month's deadlock over a new coronavirus relief bill. He called House Speaker Nancy Pelosi with a $916 billion proposal that includes aid to states and liability protections for businesses. Pelosi and Senate Democratic leader Chuck Schumer called the offer progress, but they're unhappy it doesn't include enhanced unemployment benefits. The UK will drop tariffs the European Union imposed on $4 billion of US goods. It's part of the long-running dispute over illegal aid to aircraft manufacturers Boeing and Airbus. The UK says it will set its own tariff policy when it completes its split from the EU at the end of the month. British Prime Minister Boris Johnson heads to Brussels today on a rescue mission. He'll have dinner with European Commission President Ursula von der Leyen as both sides try to save Brexit trade negotiations. If there's no deal by the end of the year, the UK faces a number of damaging disruptions, including tariffs on exports to the EU. And shares of DoorDash begin trading today. The food delivery service raised almost $3.4 billion in an IPO above its marketed range. That gives DoorDash a valuation of about $38 billion. It's the third largest US listing this year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Ritika, thank you so much. The great embarrassment of Tom Keene continues today, as it's a special day for Tom and the rest of us. We had to put together a special montage of the past few years. Tom, it's never been dull. It's not always been accurate, but it's never been dull. I mean, it's, we've had some memorable interviews, and I have to say.
Oh, we have.
I think with Christine Lagarde, do you remember when you stopped her, talking about monetary policy to ask her whether she'd seen the film Lincoln?
Yeah, well, we're not on speaking terms. Madame Lagarde and I haven't spoken, since time began. Well, there's what it's about. That's Davos. and that is our final dinner at Davos. And Anastasia Ellis was incredibly important there because by that time, Pharaoh and I hated each other's guts like we've never hate. I mean, we still hate each other's guts, but that was appalling. That's a great montage. Oh, yeah, British Air.
Have a lovely
bring
day.
The
That was probably
747
my favorite,
back.
actually.
That's my birthday wish, is that British Air would bring the 747 back. It helps when the Gulfstream's not working.
Yeah, there you go. Keeping it real, Tom Keene. Happy birthday.
We are trying. It's been a joy, and we'll continue to do this. At least we'll do this. Simulcast is, it's like 50-50 what we'll do with the simulcast. I don't know if Abramowitz is going to show up today. She was out taking photos of the humpback whale on the Hudson River in her canoe yesterday. She may be frozen over. Coming up with Apollo, Sonali Basak speaks to David Samber. This is Bloomberg. Good morning.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Surveillance worldwide. Just seeing over on Fox TV, they're reporting that Mr. Giuliani will leave the hospital today. Don't know if that's true, but that is certainly good news. And we wish the former mayor of New York City best health in his fight against the virus. Right now, single best chart. This was a chart of the year a couple of years ago, and never, ever, ever, ever did I or David Samber imagine that we would see this chart. Take the fiscal deficit, take the trade deficit, combine them together, and that is what's called the twin deficits. It's been worser for decades. And then there was a pandemic. We are out 4 standard deviations on the twin deficits, and they may have a little bit to do with why Senator McConnell and the deficit hawks are so afraid of the moment as they look at the stimulus as well. That was an important chart, and it is ever more so now in the heart of this pandemic. Right now, Sonali Basak with an exceptionally important Global Wall Street interview.
Thank you, Tom. And joining us now is David Samber, Apollo's co-head of private equity. David, over at Apollo, you run a $77 billion business. It's one of the largest private equity businesses in the world. And also, you are famous on Wall Street for putting money to work at a tough time. So what is your propensity to invest right now?
Hi, Sonali. Thanks for having me on. I'm happy to be here. You know, it's been a crazy year. I've been watching your show, and you've been talking about it all year. It's almost like we've had 4 years in one. In the first quarter, it was business as usual, and we were doing normal buyouts and monetizing our eighth portfolio, which is an $18 billion fund. There was severe disruption in the second quarter, and we put a lot of money to work, financing companies like Expedia, like Cimpress, providing them capital to get through the disruption. And in the third quarter, we had rebound, and in the fourth quarter, it's been essentially business back to usual, which I think surprises a lot of us. We've been pretty active this last quarter. We've done 3 deals in the last 45 days. This week, we announced a deal to buy IGT's Italian gaming business for $1.2 billion. We've been investing in all types of sectors, and I think that this year really has highlighted what makes our business great. You know, Apollo, I think, is known more than other private equity firms for its flexible mandate. And throughout this year, we've done basically every style of investment that we do in our private equity fund. We've done traditional buyouts, we've done corporate carve-outs, we've done capital injections into companies. So it really has highlighted the value of our franchise and the value of our business model.
David, you made some really gutsy investments at the beginning of this year. Expedia, Airbnb, Apollo was also part of a group that invested in Airbnb in the toughest times, but the market has bounced back. Are you still finding attractive opportunities now that the Fed has provided so much support?
Yeah, so I'd say different opportunities. Those types of opportunities are not really there anymore. The financing markets are wide open. A lot of those opportunities were a function of the traditional financing markets closing down, and we were a very willing provider of financing for certain companies like Expedia and Cimpress, which you named. Look, I think you have to tip your hat to the federal government and the Fed for stepping in and providing all that support. It reopened the financing markets, and it definitely took away those types of investing opportunities for us. But we're finding different opportunities. We've been pretty active in corporate carve-outs, pretty active in public to privates. So we're back doing different deals. But those particular opportunities, yes, those opportunities are largely passing us by just due to the fact that financing is plentiful, you know, and really so cheap right now.
Right. All of this investment is also happening at a time where, yes, people are doing a lot of deals, but also a lot of companies are going bankrupt. So how do you look past COVID when you're looking at these investments and putting money to work?
Yeah, look, I think that's really the trick. I've seen other people come on TV in our industry and say they won't invest in anything that was impacted by COVID. They don't want to invest in anything that's hospitality related, that's leisure related. We think that's a little bit simplistic, and we think that most people, when they adopt those approaches, miss opportunities. We've been pretty active in leisure and hospitality, in gaming, in sectors that have been impacted by COVID. Airlines, we're restructuring Aeromexico, the large Mexican airline, for example. Swissport, we're restructuring Swissport. You know, what I'll say is this. I think the trick for us is everything we look at, we ask ourselves, is it secular or cyclical? I think that the trick with COVID and the crisis we're currently in is that it's accelerated a lot of secular trends. And for us, we don't want to be investing in secularly declining industries. But for things like travel, hospitality, I do think it's possible to envision a world different than the one that we're currently living with. There will be an end to this. I do think that people will want to get out and see people again physically and experience things. And I think that's a theme that we've been happy to invest behind.
David, you've been named the co-head of this business, right? The business that was founded about 30 years ago by Leon Black. You've been entrusted with this business. You and your colleagues have given me a very interesting statistic as you look to change the business. And as you look to hire, you found that less than 0.01%, really only 95 people in the entire industry out of 18,000 people are Black. How do you change a private equity business to look more like society?
Yeah, that's a statistic that we had to research to find out, and I don't think it's a statistic that anyone in our industry should be proud of. We're certainly not proud of it. Matt and I, my partner Matt Nord and myself, have taken on championing diversity. We want to be champions of diversity. It's a core value of Apollo. And one of the things that we're focused on is figuring out how do we attract and retain diverse talent, not only at the Apollo level, but throughout our portfolio, which numbers almost 500,000 employees globally. When it comes to that statistic in particular, for our business in private equity, not for overall Apollo, the main pathway for us to recruit entry-level talent is through investment banks. And one of the things that we also studied was what is the racial composition of investment banking classes. And again, we found that it really wasn't where it needed to be to satisfy our diversity goals. So what we've had to do is work harder to develop our own pathways to recruit people. For the first time ever, we're going to universities and we're doing a lot of work to get people interested in finance jobs that may not even benefit us directly. I think that's the work that we're going to have to do as leaders to benefit not only ourselves, but benefit the industry, get more underrepresented groups interested in finance jobs, working on Wall Street, and then that'll benefit everyone. And the other thing that we've done this year and we'll continue to do is make hires at all levels. In our business, we've hired at the partner level, at the mid-level, and at the junior level with diverse hires. So we'll continue to attack it from the top and the bottom.
David, another fun fact about Apollo that I did not know before was that about 70% of the firm is millennial. It's very young. How do you build a financial company that caters to the needs of young people?
I think this is an issue not just for us, but for every company in America. I mean, that statistic does catch your eye, but you know what I like to tell my partners is millennials are over. It's now Gen Z. You know, the oldest millennial is 39 years old. The oldest millennial was born in 1981, and Gen Zs are 23, 24. So our youngest employees now are actually Gen Z. I think a lot of the things we're doing to modernize our culture, much like a lot of businesses in America are doing, are going to help attract millennials and Gen Z people into finance. Again, you have to broaden the way you think about these jobs and the people that you want to do these jobs. You know, giving people more of a balance at home has been critically important. We have a lot of affinity groups that we have at Apollo that we're very proud of. I co-chair our Pride group. We have a family network that we started this year, which was great. We did story time for kids remotely. So I think a lot of that just goes into developing, you know, not only our firm, but Wall Street and corporate America in general, making it more family friendly, more flexible.
David, thank you so much for joining us. And we really hope to have you again soon to re-up on some of this. Fran, back to you.
Shonali, thank you. It was a great interview. Angela Merkel, in the meantime, saying fair competition is vital for a deal. So we're on Brexit watch. Coming up on What You Miss, Jeffrey Jones, President and Chief Executive of H&R Block. That's at 4 p.m. in New York, 9 p.m. in London. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. Bloomberg surveillance with global stocks actually energized. Now, this in part is due to the stimulus or the proposal of stimulus that we're seeing in the United States with the White House's surprise re-entry into pandemic relief talks. This $916 billion proposal that opened a potential new path to a year-end deal. You can see global stocks climbing towards another record high. The hope of a stimulus is overshadowing fears about resurgent coronavirus cases. And then the other stories we're looking for in the market. We understand that U.S. private equity firm Platinum Equity is also nearing an agreement to buy Ingram Micro from NHA. That's a nice Bloomberg scoop. And then, of course, we're on Brexit watch with Boris Johnson having dinner with the Commission president later today. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I'm not a strong believer in Bitcoin. For all the reasons it's a strong developing asset class, it may fail.
Take
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Businesses in our city, in our state, in our country, quite honestly, are not going to return from this.
People are at as stretched as they can be almost.
The tea leaves have never been harder to read.
The productive sector of the economy has been very much sheltered in this shock.
I worry that markets are getting ahead of the politics.
Fiscal stimulus isn't there yet, and you've got a complete lack of coordination.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. With your equity market adding to the record highs at a close on the S&P 500 and on the NASDAQ, the S&P up by 5-6 points. We advance 0.15%. And you've heard the talk, Tom, that somehow we're making progress down in D.C. I hear a lot of noise. I see a lot of movement. I sense very little progress down in Washington.
Well, as you know, John, the news gets made in the late afternoon and into the early evening in Washington, and the shift for our viewers who missed that, our listeners who've missed that, is real simple. There's now talk of a single $600 check. I don't know how you sell that to a huge part of America flat on their back. Matthew Lazzetti at Deutsche Bank re-emphasizing an all-in 12% unemployment rate. That's a Deutsche Bank calculation.
Different sounds, same story, Tom. That's the issue down in Washington right now. Same issues. Liability protection, point one. State aid, point two. And Leader McConnell's saying, let's put those 2 points aside, agree on what we can agree with, and revisit those 2 points in early January. That's his position at the moment. I have no idea. In fact, we do. We have a clue from the Democrats as to whether they're going to come along with that right now. Doesn't look like it.
Well, that's a split of the nation, and with it, you see the markets moving up. I love Ben Laidler's note out moments ago where he really says, look, this market is moving so fast for the elites, for the haves of America, that he's even seeing his sentiment statistics really roll over. He says only 6 times in 14 years has he seen sentiment so up. There's no other way to put it. I know that'll be a huge theme this morning.
No doubt. Lisa, sentiment, the narrative, seems to be written by wherever the market closed the day before. How many times have we read that headline? Stocks are up because of stimulus talks. I think the perception of how stimulus talks are going are basically shaped by what is happening in this market. For the conversations we're having anyway, that seems to be what dictates them at the moment.
I think that you're right to point out that there's been no change in the language, but there has been a change in the political pressure, especially post-election. And I think that is sort of the question, especially heading into that January 5th Georgia election that's going to determine the dominance of Senate. Meanwhile, as you both were talking about, there is a greater sense of urgency as you see the economy continue to slow down. I'll be watching 10 a.m. U.S. October JOLTS job openings report. This is a leading indicator of the jobs market. There you go. You can see initially there was that V, that spike up, and now it has been decelerating. Could that add to this feeling that we're losing momentum? Meanwhile, at 10:30 a.m., we're going to get the EIA crude oil inventory report. I know scintillating. Both of you are hanging on the edges of your chairs. However, there has been a steady increase in the inventories of gasoline, basically indicating that people are not driving around as much. This means less commercial activity. Again, deceleration, adding to that sense of urgency. And at 1 p.m., the U.S. is planning to sell $38 billion of 10-year notes. This will be interesting, especially ahead of next week's Fed meeting. How much are investors going to be buying at a time of expectation for the Fed to come in and put their foot on yields and bid up prices? Or are people going to take note of some of these inflation forecasts from Jamie Dimon and from Jeff Gundlach? You're laughing, John Farrow. I can hear you talking about how inflation's going to just take off and accelerate next year.
Look, this is going to be This is going to be a theme this morning. John, jump in here. This is really, really important. We have seen this, John, for over a decade of people modeling out a higher interest rate environment. time after time after time, it hasn't happened. Dominic Constant at Credit Suisse years ago had the mother of all charts on this. It's been the great missed call of, I'm going to say, 15 years.
I think whenever the CEO of a bank starts making calls about markets, it makes it very awkward for everyone who works at the bank. When that issue comes out a little bit later,
John,
you're telling me JP Morgan have nothing to do with 10-year treasuries now because Jamie
Mr.
Dimon
listens and watches. Mr. Dimon listens and watches every morning, you guys. And let's be clear. Joyce Chang, John Norman, Jan Lois, and the rest of them, they don't agree with their CEO's call on debt.
Well, they didn't back in 2018 either when Jamie Dimon said you better be prepared to deal with rates 5% or higher. That never came around. Jamie Dimon on the equity side of things, when it comes to his own stock, has been prolific. I remember in February 2016 when we had that huge growth shock around China and he stepped back in and basically ticked the bottom of the market when he started buying JP Morgan stock. But on the bond market, Tom, we've seen it time and time again. The people who are expecting yields to climb and yields keep going lower. I know you caught up with Steve Major of HSBC a little bit earlier this morning, and he's out there saying 75 basis points into year-end 21.
Then we've got the perfect guest to carry this forward. Let's get to it.
Jim Caron of Morgan Stanley joining us right now. Jim, weigh in. I know it gets awkward when the CEO of a bank starts to make a call, but it's not your CEO. And I haven't heard Gorman say anything about 10-year yields recently. So what are you looking to happen in 21?
So we are looking for yields to drift a little bit higher. But, I think a lot of these calls for inflation and significantly higher yields are very, very premature. I don't see this really until maybe 2024, 2025. And let me go through the reasoning and rationale for this. The point here is that we have a pretty significant output gap. So trend growth in the U.S. is just under 2%. It's just about 2%. And we grew this year at about -3. So therefore, we're below trend growth by 5%. Now, that miss in trend growth is what we call an output gap. And the question that everybody asks themselves is, when are you going to close that output gap? Because that's when aggregate demand comes back into the economy, and that's when you have more demand that pushes prices higher. So until the output gap closes, you don't really get higher inflation. Now, by my calculations, we would have to grow at 5% in 2021 in GDP in the U.S. and 5% again in 2022. And that's beyond most forecasters. In other words, for next year, many forecasters have 5 or even 6% growth. But then the following year in 2022, most forecasters have somewhere between 2.5% and 3% growth. So we're going to fall short. So what do we need? We need a significant amount of, whether it's fiscal stimulus, continued monetary support, in order to get these animal spirits moving higher, to get prices moving higher. But right now, it looks like we're falling short of that. So it's not that yields can't start to rise. We're seeing that with break-evens. 10-year break-evens are around 190 basis points. Real yields are falling. All of this is a reflection of expected stimulus, whether monetary or fiscal. But we're not actually seeing the delivered inflation really coming into goods prices. And that's really the key. And unless we get that, it's going to be hard to have a sustainable rise in 10-year Treasury yields beyond, say, 1.25% or 1.4% next year, for a moment. But that would just be a natural adjustment, not an inflation scare.
125 on a 10-year. The idea that inflation and this reflationary narrative doesn't evolve, doesn't materialize. That's your position, Jim, going against the consensus on that point. But when it comes to risk assets, you're perfectly aligned still with the crowd, Jim. Why?
Yeah, well, because, I think that there's a shortage of securities, for one. There's a lot of liquidity in the marketplace and not enough securities. Corporate supply next year is going to probably be lower by, in terms of net issuance, it's going to be about negative 500 billion. So we have about 1.8 trillion in investment grade. Next year, we may expect around 1.3 trillion. 1.8 trillion, yes, this year, and 1.3 trillion probably for next year. The Fed is doing QE, and the Fed continues to buy, 80 billion per month. They may even extend their maturities next week. So the point here is that there's a lot of money, which by design is out there to flood the markets, and there's just not enough security. So there is going to be demand for yield. So yes, it is a little bit counter consensus, but the point here is that fiscal policy and monetary policy together will actually stabilize the markets quite a bit and keep interest rates relatively low. I mean, I think rates rise a little bit, but I don't think they rise as much as what, some may be thinking that they might, just because there's just so much cash on the sidelines that is looking for places, looking for yield, and it will come into these markets.
Jim, we've gotten a little bit philosophical in the mornings on Bloomberg Surveillance, and your note had a very philosophical undertone, the idea that there is this incredible divergence and tension between asset prices that continue to rise due to some of these interventions from policymakers, and that fundamentals really are not catching up. What's the breaking point for that?
Yeah, well, eventually it does break down. So look, I mean, essentially what we need to have is aggregate demand come back into the marketplace, right? If that doesn't happen, then all we're going to do is stretch valuations more and more. Here, let's take this as an example. Investment grade credit spreads in the U.S. is trading at about 100 basis points. High yield OAS spreads is under 400 basis points right now. So we've brought forward a lot of the performance in the market at this point for 2021. So in other words, 2020 was about a promise. Fiscal stimulus, monetary stimulus, and we hope that things are going to get better in 2021. So all that performance has been brought forward. If we don't deliver on this growth in 2021, so 2021 is about the delivery of the promise versus the actual promise that was made in 2020. If we don't deliver on this promise in terms of growth, then these asset prices are going to look a little bit expensive, and there could be an adjustment downward in price to reflect the fact that we're not growing fast enough. It's not that we're not going to grow in 2021.
Yeah.
Is will it be enough? And if there's not enough,
Jim,
asset prices will address down.
I'll tell you a great story about 2022. Just you wait. Jim Caron of Morgan Stanley Global Fixed Income.
Just you
Thank
wait.
you, sir. You know how this works, don't you? Even if we do get that downside surprise, we miss expectations in 21. There'll be someone telling you about a beautiful story of 22. A beautiful story, Tom, a normalization. Things getting back to normal.
Yeah.
Growth rates. In fact, we're going to go above trend growth. Maybe even the Fed will think about raising interest rates. It'll be that good in 22.
What I know, John, it's a single missed call of the last many, many years, and that is a statement by people in ties and bow ties and women in fancy dresses that it's a single-digit equity world. It has been wrong, wrong, wrong. There's no other way to put it.
Oh, this year's been phenomenal. Talking about the doubters, Lisa, the bond market, Europe, Portugal, sub-zero on a 10-year.
Yeah.
Everyone came out calling it totally crazy. That's the bond market in Europe right now. That's the reality.
And the ECB is expected to continue to add to that power and that rally. I will just note, $5.6 trillion. That is how much the major central banks around the world have added in quantitative easing purchases this year.
See, this is great.
The numbers
I'm
are
talking
incredible.
equities, and you guys are
Absolutely
talking bonds.
incredible.
I mean, it's like
We're
Mars
talking
and
past
Venus
each other,
here.
Tom. That's
Cholula.
what we do.
Is anybody
That's what we do.
Birthday.
Just because it's your birthday doesn't mean we're going to stay on script with you.
Why am I here?
Coming up,
supposed to get, like,
Mark
a month
McCormick
off,
of TD Bank on the ECB decision coming up tomorrow. For our audience worldwide this morning, good morning. This is Bloomberg.
With your first word news, I'm Ritika Gupta. The Trump administration is making its first move since Election Day to break a long standoff over a coronavirus relief package. Treasury Secretary Steven Mnuchin's plan calls for $916 billion in spending. It would include aid to the states and liability protections for businesses. House Speaker Nancy Pelosi called it progress, but she said it shouldn't disrupt negotiations already underway. The U.S. government has an ambitious plan to vaccinate most Americans by next summer, but it rests heavily on 2 coronavirus shots that U.S. regulators won't get a chance to rule on until early next year. AstraZeneca and Johnson & Johnson together would provide up to 200 million doses of vaccine in the first quarter. The Supreme Court has dealt a sharp blow to President Trump's efforts to overturn the election results. It rejected a request by some of his allies to overturn Joe Biden's victory in Pennsylvania. The High Court's decision came in a one-sentence announcement and didn't say whether any justices dissented. There's a deal to unblock the European Union's $2.2 trillion budget and stimulus plan. Poland and Hungary have agreed on a compromise with Germany. That's according to the Polish Deputy Prime Minister. Poland and Hungary had vetoed the funding plan. They objected to tying funding to the adherence of rule of law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is we set aside liability and set aside state and local and pass those things that we can agree on, knowing full well we'll be back at this after the first of the year.
Senate Majority Leader Mitch McConnell looking to lay aside some differences and maybe agree to a deal down on Capitol Hill. Will the Democrats come along with him? From New York and London this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. Let's get the price action this Wednesday morning. Shaping up as follows on a record high in the S&P 500. We add some weight to it, up 7 through 3,700 on the S&P. We're up another 0.2%. In the FX market, ahead of the ECB, about 24 hours away and change. Euro dollar 121.12 and up about 0.1%. Euro showing just a little bit of strength, though off the highs for 2020 that we had last week. And in the bond market, Tom, just a little bit of a lift, up about 2 basis points, no drama on a 10-year, about 94 basis points this morning.
Yeah, but I'm glad you point that out, John. And it's really germane. The real yield right now, the 10-year real yield, negative 0.9785. So it really correlates in nicely again with equities lifting up. I want to get this out of the way quickly with Kevin Cirilli, our chief Washington correspondent, because I know John and Lisa really want to talk about a single $600 check. Kevin Cirilli, Timothy Bell over at the Post, talking up the Nevada decision last night late. This is new news. 6-0, they voted against Trump and allies on the Nevada elections, and they talked about one single phrase: to demonstrate error of law that did not occur. Have we ever seen an error of law in any of this presidential litigation?
Well, look, I mean, all of these cases, now close to 40 cases at least, have been tossed out by judges across the country. And so I think what you've seen in Nevada, as well as what you saw with the Supreme Court in regards to Pennsylvania, is really a continuation that the results are not going to be overturned. Now, I would say the following is that just several months ago, in conversations and reporting that the entire industry had done about the potential risk for the judicial branch of the United States government to be intensely politicized, akin to the 2000 election, that simply hasn't been the case. And so even in these incredibly polarized times, the Supreme Court of the United States has not been wrapped into a large, questionable and polarized political fight.
Meanwhile, if you talk about questionable and polarized, let's talk about stimulus talks that are continuing in Washington, D.C. Steve Mnuchin, Treasury Secretary, entering the fray with his $916 billion plan. A lot of people using this as a justification for renewed optimism in markets. John was talking about how you're not seeing any distance bridged in the actual language. Has any progress been made?
Yes, significant progress. I think even the fact that the administration has come out with a proposal from Secretary Mnuchin, coupled with the continued rhetoric coming from Senate Majority Leader Mitch McConnell. Yesterday, I spoke with one Republican lawmaker in the House of Representatives who essentially told me that they are still incredibly optimistic that this will get done in the next 7 to 10 days, even if there's only a $600 fiscal stimulus check. And yes, that will mean Senator Bernie Sanders and Congresswoman Alexandria Ocasio-Cortez will likely, they've already said they're not going to vote for this. The ability of Leader McConnell to give up this issue of liability protections is a very significant bargaining chip that has emerged in these talks.
Well, Kevin, he's only saying he'll give that up if Speaker Pelosi and Minority Leader Schumer give up on state aid. Any sign that they're willing to do that?
You know, to be candid, I think when you look not necessarily at the language that Speaker Pelosi is using, but other top Democrats in the House of Representatives, like, for example, Steny Hoyer and others in that circle that really revolve around the orbit of Speaker Pelosi, yes, I do think that they would be able to get behind that, provided that, and this is where it's Washington speak, provided that aid to state and local governments could be retranslated into grant programs for state and local governments, in which case, you know, it's defining something on someone else's terms.
Kevin, Washington speak. That's not playing on West 55th Street in New York. It's not playing on streets John Farrow knows in London. When does Washington speak wake up and listen to the nation, both Republicans and Democrats?
Well, you know, I think that two things. First and foremost, the conversation that you're seeing now on fiscal stimulus is likely going to continue down to the wire. But secondly, is that yesterday the president-elect, Joe Biden, announcing that he is promising essentially 100 million vaccines in the first 100 days of his administration. So without question, the incoming administration is really saying that the vaccination rollout...
I don't mean to interrupt, but this is so important. I was just talking with Michael from Bedford moments ago, and Michael from Bedford said to me, why are we counting 100 million? What are we doing about business in America? And I don't mean big pharma or big technology like Bloomberg. What are we doing right now in Washington speak about small business America?
You know, look, I mean, this is where it comes down to with the grants as well as the loans. And I think if you look carefully at what Senator Marco Rubio, Republican of Florida, the Ben Cardins of the world, Democrat from Maryland, at what they've been pushing for, French Hill of the world, the Republican from Arkansas in Congress, what they've been pushing for are grant protections and grant and access to Main Street. Look, you know,
the economist John Farrow has this nailed. We're looking for income substitution.
I feel like this is a broader conversation that you and I should be having. I know you like the St. Regis, but because it's your birthday, I would take you to the Hay Adams. I take all my favorite people to the Hay Adams because they've got a great green smoothie for breakfast. So I feel like we should continue this, but you know,
it's closed
over a liquid breakfast.
We could have John Malkovich join us. We could have John Malkovich join us. By the way, it's also John Malkovich's birthday.
Happy birthday to him too, Kevin. Thank you. Kevin Cirilli, Bloomberg Chief Washington Correspondent down in D.C.
John, I don't want to take over the show, but John Farrow, you've absolutely nailed this. I'm sorry. You're the only one I know in media who's nailed this. It's about income substitution, income replacement.
Well, if you're going to tell people to stay at home, you have to offset that. Otherwise, how can you expect them to comply with the advice that they get from state and local officials? That's the story. And I think it's so painful for small business, Tom, for restaurants to be told they've got to close up shop, that they can't do business. Now, to watch a restaurant go under, and we've talked about this on this program all year, it is brutal to watch loved ones go through that, Tom. It really is absolutely brutal at the best of times. But to be told you can't open up and even try to survive, that's even worse. And to have those same officials tell you you've got to do that and then not offer you the help off the back of it, Tom, I'd use a stronger word, but that just isn't on at all.
I mean, quickly here, Lisa, I mean, Tom Brady's a football player, Lisa, and they were talking about he's got some business transaction where he got a lot of the small business aid. I don't know. But just, I think everyone out there right now agrees at how unfair all this is.
Yeah, actually, if you look at Gary Cohn, the former head of the Economic Council, he put out a Twitter post yesterday that I thought was fascinating, talking about the disconnect between the stock market and small businesses truly struggling, John.
From London and New York this morning, good morning to you all for our audience worldwide. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up on the programme, Mark McCormick of TD Bank. Looking forward to that. Futures adding some weight to the rally and the record highs, up 6 on the S&P. This is Bloomberg.
have some good news in terms of vaccines and a chance to overcome the health crisis, but but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
When you call somebody, any head of state in the world, how hard is it for you to get anybody on the phone? I assume not too hard.
I would say it's not too hard, but sometimes it takes a week.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Record highs coming into Wednesday morning. Good morning to you all worldwide, live on Bloomberg TV and radio. This is Bloomberg Surveillance, and here's the price action. A record on the S&P, we add to it, up 6 on the S&P 500. 10-day winning streak on the NASDAQ 100. Look out for that longest winning streak of the year so far for big tech. We pulled back just a little bit on NASDAQ futures, off by 1/10%. But there's the number, through 3,700 on the S&P 500. Already getting to Goldman's year-end target with a few weeks to spare, and they're looking for 16% more upside through 21. Switch up the board. I get to another call in the bond market. It comes from Jamie Dimon, reportedly saying he wouldn't touch 10-year Treasury yields here with a 10-foot pole. Those comments made yesterday. The discussion will continue today. This morning, yields higher by a couple of basis points to 0.9394%. Looking at what's happening across the continent, in Europe, on the other side of the Atlantic, sub-zero on Portuguese 10-year debt. Switch up the board and get to FX, and we'll talk about the ECB. Frederic Ducrozet, a regular guest on this program, pointing out that given what he expects from the ECB tomorrow, the European Central Bank next year could buy 70% of all the bond supply that comes from European governments through the entire year. 70%. That's not net supply either. That number's much higher. In the bond market, you've seen the story. Here's the story for foreign exchange. Euro-dollar, Tom, going into that meeting, 121 flat. Tomorrow, I've got to say, is a big one for Christine Lagarde and the Governing Council.
Turning Japanese, I really think so, is really what it sounds like as we go on another year here, and some of the great challenges we see in this time of output gap, which is one of the themes this morning. We spent a lot of time on politics this morning, a lot of time on the dynamics of Brexit thing, Boris having dinner in Brussels. How about the markets? We speak with Mark McCormick of TD, Global Head of Foreign Exchange Strategy. Mark, I want to take bull sentiment in the equity markets, most visible to the public, and I want to bring it right over into the great litmus paper of the system, which is your world, which is dollar dynamics. When we see bullish sentiment like it is right now, what does that do to foreign exchange and dollar dynamics?
So thank you. Yeah, what it absolutely does is pushes the dollar down. So the way that this works is the way that the world is pricing reflation, steeper yield curves, higher commodity prices, some pickup in emerging markets, at least most focused in Asia. A lot of that, what it's doing is pushing the dollar down, because what you're kind of seeing is there's expectations that the global economy is going to rebound next year, and that we're going to kind of move past this COVID phase. This is exactly what the dollar is pricing. And the one thing we've tried to articulate to clients is if you have a view on equities, or if you have a view on the global yield curve, you also inherently have a risk with the dollar. So it is one giant trade driven by the same global dynamics, regardless of how you want to look at it across markets.
I'm glad that John Farrow talked about the ECB coming into this segment, talking about how you're seeing an ongoing push to buy assets there. When you talk about the dollar, this is related because you are seeing strength in the euro, and at what point, this is the angst that people are talking about, at what point will the ECB care? And John's talked a lot about this. My question is, can the ECB do anything to change this dynamic, given the pressures on a weaker dollar that go far beyond monetary policy?
Yeah, I think part of what they can do is stem the rally. The point that we've been trying to articulate is that there's an element here that the global reflation trade is just way too optimistic, at least relative to how it's pricing in growth markets. If you look at mobility and consensus expectations for growth next year, the dollar should be about 2 to 3% higher, and global equity should be about 4 or 5% lower. So the markets are already way ahead of the optimism that may actually not even be delivered next year, given the complications around vaccines or logistical issues. But for the ECB, what they can try to do is at least stem the rally. And I think markets are already trying to get ahead of that since the euro has not really been able to add on momentum the last couple of days. It seems to be fading as we get to 122. But this is very, very close to the melt up that we saw in 2017, which is euro just rallied exponentially in a short period of time and then it stalled out. And I think a lot of these things is, people might say this is cause and effect. The ECB is basically causing the euro to stop. I think it's a bunch of factors. The ECB can be a catalyst to basically help what would be a positioning-induced squeeze. But what is most important is Europe is still not a growth leader. And what we've saw on COVID and what we've seen over the last 6 weeks is European mobility data is collapsing. And European economic growth indicators that we are tracking also suggest the euro shouldn't really be above 120 right now.
So, Mark, let me ask you this. Is ECB QE euro positive or euro negative? If they disappoint tomorrow on the size of the package, what does that do to the currency?
Yeah, I'd say euro rallies if they disappoint. So if we don't get enough liquidity, like if they're not seen using the balance sheet to, they've tried to talk down the euro. If they're not seen using the balance sheet to try to limit the appreciation in the euro, then it's bullish for the euro because it kind of justifies the signals and the momentum that people are trying to trade this on, a weak dollar story. This isn't a positive euro story. It's a weak dollar story. So in that environment, I do think if the ECB disappoints, it's just kind of a signal that they're willing to accept less inflation and a stronger euro, which would, kind of reduce some of the credibility in terms of the things that they've been trying to tell the market that matters to them. So absolutely, disappointment, higher.
So, Mark, to some degree, then, you think rate differentials matter here in the traditional way, that if they don't push yields down any further, the euro's got an advantage?
I think real rates matter, and I think the expectations around balance sheet growth are still important, while the most important factor to me is still growth and relative equity momentum. And so, we're not seeing Eurozone related equities match the movements we've seen in U.S. and Asian equities. So, the Eurozone has a strong balance of payments and it's got a current account surplus that insulates it. And we've also seen the rally in the euro kind of reduce the pricing gaps that you'd looked across normal interest rate channels. But real rates here have collapsed in the U.S. and are just higher everywhere else in the G10, whether that's right or wrong. But essentially, you're not trading the euro as much on rate differentials. But what you're hoping is that if the ECB is willing to use the balance sheet to kind of stem the appreciation, or at least induce more stimulus, then that's just negative for the euro, at least in a very short-term manner, because they're trying to actively push it down.
Mark, you mentioned moments ago the dreaded phrase, the dreaded adverb, exponentially. Usually that's associated with enjoying losing money. As we go into 2021, how do I play the speculative FX game, not to make money, but not to lose money?
Yeah, it's a great question. I think if you think about it, there's a couple different themes. I think the reflation theme is relevant. I do think over time it's moving in the right direction, but our view right now as we move into year end, and it's just too optimistic versus all the potential bad things that can happen. I would call this a cognitive dissonance trade. There's a lot of good news being priced in, a lot of bad news ignores. So I do think that there's a room for the dollar to weaken, but this would, in G10, this is a stronger yen. So I think that's the clear takeaway. And in emerging markets, our EM team really likes the story in China. And also the carry trade. So you're long Indonesia, you're long India, you're short Taiwanese dollar, and then to play on the growth impact that comes through on the reflation side in Asia, you're long China versus Taiwan. And I think, you could see the bias here is regionally focused on Asia. But I think euro, you have to think about this is going to be something that's going to be driven, I think, by month-to-month dynamics, which I don't think is a one-way drive. And I think euro probably still peaks around 125, even if we get the optimistic outcomes next year.
So just to tie this all together, Mark, because you're saying that basically there might be a little bit too much good news priced in, and yet you seem to agree with the consensus baked into markets of a weaker dollar, a stronger yuan, and even a stronger euro from here. Where would you push back against the consensus trade right now?
The fact that it is consensus is challenging, right? We're all forecasting a year out amid a pandemic, and as you talked about in your prior segment, there's potentially a lot of structural changes happening in the labor market. And if you kind of overlay what the major meta theme is there's complete dislocation between globalization and if you want to call it populism, or just the general public's feel on globalization. So while Biden will represent a change in foreign policy, the meta theme of globalization and, this age of, I guess you would call it disruption, is not going away. So we're still going to live with extreme geopolitical uncertainty. We're still going to live with event risk that has to come through all kinds of elections. And the fact that information is just dispersed throughout the world rapidly. So I would say that, the risks is that all of these things that are happening so quickly and are changing the markets rapidly are not going to go away. Those things are likely to accelerate. So I'd say, our view is the things that we can map and the things that we can forecast, which is the global economy is in a better position than where it is right now, is dollar negative, largely because our dollar valuation models are overvalued and the U.S. still has very low real interest rates and is likely to repress them further.
Mark,
Yeah,
sure. I don't mean to interrupt, use Tom Keen's line because it's his birthday, so I can appropriate his comments. But, what you're saying is consistent with what other people are saying as well, which is basically the consensus, the very strong consensus makes us nervous, but we agree with it and are jumping on it. So as an investor, what do you do? Do you hedge? Can you hedge given the fact that we're in such a low return, low yield world?
Yeah, so I'd say the part of the being out of consensus is where we're at now. We're getting a lot of pushback on our view that you should be fading these extremes. You should be selling the euro. We're actively short the euro right now. We're short the Swiss franc. And we're pushing back on the reflation trade as we start the year end. We are getting significant pushback on that because this is a momentum trade and everyone likes the fact that momentum generates easy returns. So I'd say right now being out of consensus right now is actually saying that the dollar's kind of reached a short-term peak and that there's room for it to rally 2 to 3%, which means equities would come off. So that in itself is entirely out of consensus. So we're calling for a drawdown, but at the exact same time saying that's a good opportunity to re-engage. If you get a 5% pullback in risk assets, start to load back up maybe in early Q1. So I'd say our forecasts are generally in the the premise of consensus, but the tactical and the strategic way that you should trade it is completely out of the market mindset right now.
Mark, love catching up. Great to hear from you. Mark McCormick there
really
of
good.
TD. Euro
really
dollar, 121. Almost 121 flat going into the ECB tomorrow. I have to say, Tom, it's really finely balanced. If the ECB delivers an upside surprise, a downside surprise, how the euro would respond to that, negatively or positively, either way. And I can find people that would argue both sides of that.
I mean, I don't mean to interrupt, John, but yeah, I think it's absolutely true. There's no question about it. There's some huge ambiguity out of this meeting. But what's so important here about Mark McCormick is it's nice to hear from somebody who's really pushing against a consensus call right now.
Just a little bit, yeah. On the euro, Tom, I've got to say, if they deliver something big tomorrow, is that euro negative? If they deliver something big tomorrow, doesn't that make people a little bit more constructive on the continent? Could that be
on a
euro
first order
positive?
condition, I go with you. But I mean, again, I don't mean to interrupt, but I think it's really, really important to see here what we do. I mean, I really.
Lisa, what have you started here?
Oh, I love this. Keep going.
What have you started here?
What have I continued?
I'm just going to stop.
Oh, are you?
Coming
Are you pressing
up,
your mute button? You're pressing your own mute
Smith,
button.
Renaissance Capital co-founder and principal. Just doing as I'm told. That's coming up next on the program. For our audience worldwide, good morning to you all. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Treasury Secretary Steven Mnuchin is trying to break the months-long deadlock over a new coronavirus relief bill. He called House Speaker Nancy Pelosi with a $916 billion proposal that includes aids to states and liability protections for businesses. Pelosi and Senate Democratic leader Chuck Schumer called the offer progress, but they're unhappy it doesn't include enhanced unemployment benefits. The UK will drop tariffs the European Union imposed on $4 billion of US goods. It's part of the long-running dispute over illegal aid to aircraft manufacturers Boeing and Airbus. The UK says it will set its own tariff policy when it completes its split from the EU at the end of the month. British Prime Minister Boris Johnson heads to Brussels today on a rescue mission. He'll have dinner with European Commission President Ursula von der Leyen as both sides try to save Brexit trade negotiations. If there's no deal by the end of the year, the UK faces a number of damaging disruptions, including tariffs on exports to the EU. And shares of DoorDash begin trading today. The food delivery service raised almost $3.4 billion in an IPO above its marketed range. Now that gives DoorDash a valuation of $38 billion. It is the third largest US listing this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Has done a good job with a couple of deals they've done. So asset management, my line is open.
It's a scale business, it's a distribution business, it's a brand business. It's got to make sense. It might be software, it might be fintech. We have lots of investments in some fintech companies we partner with. It might be something overseas, but yeah, we're open-minded. You got a billion ideas, give me a call.
1-800-DIAMOND. Steve Major of HSBC on line 2. He does not want to talk about M&A. He wants to talk about the bond market. Jamie Dimon at JP Morgan there. On M&A, quite a remarkable statement there, Tom, from the leader of JP Morgan saying he's ready to go. Give me a call, give me some ideas.
Well, the constraints are there. I mean, they have huge constraints on deposit, too big to fail and all that. But I must admit, John, I really noticed that was quite a comment from him. But it really speaks to what you see within this competitive landscape of one great roll-up, and whether you'll see, John, one big combination as we move forward. Catherine Mann at Citigroup has really led on this thinking.
I want to touch on the market quickly before we get to our next guest on IPOs. Equity futures just rolling over a little bit on the S&P 500. We're still positive by about 0.1%, up 3 on the S&P 500, another record high, and we add just a little bit of weight to it on the S&P through 3,700. In euro-dollar land, euro-dollar 121.06, pretty much dead flat on the session too. Yields coming up a couple of basis points, no drama here, back to about 94 basis points on a US 10-year. The main event really, the main scheduled event now, on the horizon, in the diary, is the ECB meeting about 24 hours away, Tom.
That is the economics of the moment, and that's what we do best here. We're thrilled you're with us on radio and television. Right now, an adult conversation on the moment in initial public offerings. Kathleen Smith has provided terrific leadership at Renaissance Capital on clarity of thought on the frenzy of the moment in IPOs. We cleared the air with her this morning. Kathleen, thrilled to have you with us. You know where I am on this. I'm hugely skeptical. Is this a manufactured boom as technology companies keep private ownership and release an ever so slight public amount, thus creating a bidding war for that ever slight public amount of shares?
Sure. Well, you can look at it. Let me just back up by saying that 2020 is not only going to be in the record books regarding COVID, but it's going to be in the record books regarding. And this year, we've seen $1 billion IPOs than any year on record. When you talk about the squeeze of a small amount of float to the larger value of the company, we're seeing very large deals. These aren't little deals like we saw in 99, 2000. So they're in the case of DoorDash, which is going to open for trading today, that was the largest IPO so far this year. They do have very big market caps, and they're going to have to, they'll expand their tradable float eventually. But your point on, is it a squeeze? I think there's always a challenge of pricing right in the supply and demand, but eventually they settle in, and they have to be connected with the overall market, which itself is pretty frothy these days.
Yeah, well, Kathleen, I want to talk about the froth. And I want to just sort of zoom out, if you will, at the $160 billion raised in U.S. IPOs so far this year, breaking records at a time of incredible economic distress, with companies that were left for dead earlier in the year coming out as darlings with much higher valuations than expected. Do you see signs of froth in the latest valuations of Airbnb, which is expected, and DoorDash, which is going to trade today?
Sure. We have specific opinions about each of those companies. We think DoorDash looks pricey to us. We think Airbnb, maybe not so much. So I think you have to look at the company and its trajectory. But if we step back a little bit and look at overall what is making the market so open right now for issuance, one is that investors have earned positive alpha returns on the existing set of IPOs that have come to market. And we have an index, the Renaissance IPO Index, that has shown very strong returns. Now, the reason that the returns have been strong, which actually begets more issuance, but the returns have been strong because interest rates are low, as we all know. And then post-COVID, the digital economy has really accelerated in its integration in our lives, and also the biotechs and vaccines. So the digital stocks, the biotechs, are a very common constituent of the U.S. IPO market. That is why these companies have done so well. Their growth has accelerated based upon current economic conditions.
Yeah, although you're looking at the Renaissance IPO ETF, which you said has performed very well. Understatement, it's returned about 120% year to date, and you said that basically people chasing returns. You've got Jamie Dimon looking for 1-800-CALL-ME to get any deal done of any sort. At what point do they have to prove that they're worth this at a time of really economic uncertainty, despite all the liquidity pumped into the market?
Well, that's the challenge for DoorDash, for example. With DoorDash, you have a company that's growth has soared due to the pandemic. Everyone wants food delivery. But what's going to happen once we get back to normal life? That growth trajectory has to drop. And that's the key challenge in analyzing DoorDash. In the case of Airbnb, that company's business has totally fallen apart with COVID, and they're now digging themselves out. I think in an interesting way. They've had a restructuring that's gone on with the company. So we're looking at Airbnb as a company that's going to be forward-looking on a positive note. Valuation's going to matter.
Kathleen, when I read, and this is ancient history, folks, there was a thing called a red herring, and you read them. And the first thing you did is go to the capitalization. I'm seeing on the Bloomberg a preferred equity tranche of DoorDash that would choke a horse. I mean, again, I look at these as manufactured transactions to create scarcity. What about the so-called preferred equity in DoorDash? Is that a tangible private investment controlled by private shareholders?
I think you have to look at some of these are convertible preferred, so they become equity at the time of the IPO. But I would point to you when we think these companies are, and they may be expensive, it'll prove itself out in the market.
Fair.
But when you look at companies like Zoom, that company's been public for less than 2 years. Do you question the value of Zoom? Or Moderna that created a vaccine? It's hard. These companies are new. They take time to be analyzed and figured out in the context of the overall market.
Kathleen, wonderful to catch up with you. Thanks for your time this morning. Kathleen Smith there of Renaissance Capital. Thank you very much. And Kathleen nailed it in many ways on a number of issues, just talking about IPOs, Tom. They're the most important thing sometimes, and it's rather unique to financial markets and how people interact with any given market. The only thing that matters is price. When price starts to go up, people have confidence. And the higher prices go, the more confidence they have in the process. In many ways, Tom, and you've studied economics, a bit like a Veblen good. The more expensive it gets, the more valuable it seems to become to other people.
The only reason I put up with Pharaoh, folks, is he quotes Torsten Veblen about once every 90 days, which is a good and beautiful thing. The bottom line is on that preferred, it's convertible, which means they pick up equity ownership with dilution. And to me, it's a whole new world after all, John.
Were you paid to quote that?
It's a
whole new world. Is that because you wanted to burst out into
No, it's because I want to interview Iger, but
birthday.
David Weston talks to Iger after all.
He doesn't want to talk to you.
Let it go.
I want to whine.
Let it go.
Lord.
Yeah. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Businesses in our city, in our state, in our country, quite honestly, are not going to return from this.
People are at as stretched as they can be almost.
The tea leaves have never been harder to read.
The productive sector of the economy has been very much sheltered in this shock.
I worry that markets are getting ahead of the politics.
Fiscal stimulus isn't there yet, and you've got a complete lack of coordination.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene from New York and London. We say good morning to all of you on Bloomberg Radio and Bloomberg Television. An exceptionally busy news day, no question about that. We'll look at the equity market. Sam Stovall with us here in a moment. John, I really must go to what I know the least thing you want to talk about, which is dinner of the Prime Minister in Brussels. We've been Brexit-free for the last 2 hours. Let's dive into it right now.
Let's change that.
Why is this important, John, for England that the Prime Minister take dinner on the 13th floor of the Berlaymont?
Well, let's question the premise of your question. Why is it important? I don't know how important it actually is, Tom. I think it's only as important as they think about where the deadline is for this, and I have no idea where the deadline is. You're not going to catch me sitting here live on TV and radio talking about the 11th hour, the last minute, the last attempt, because how many times have we done that over the last 4 years?
Let's review history. The last 4 years, so it was in the first day after Brexit, John Farrow doing a 3-4 hour stretch in London, and we were saying exactly the same conversation. The same cannot be said, John, about the ECB, where it's become an emergent meeting here that we'll see this week with Madame Lagarde. What do we expect?
Now you've got my attention. Okay, so this is what people are expecting. A bigger package and a longer plan. So the package would be upped for the asset purchases, but they'd run over a longer time horizon, so maybe another 12 months or so. It's going to be a commitment essentially from the ECB to stay in the bond market with immense flexibility for a longer period of time. And that's largely one of the reasons what we've seen. Portuguese 10-year yield sub-zero in the last 24 hours, Tom. Yesterday. It's a real weight on the bond market across the curve, across Europe?
Well, there is a big meeting for the ECB, and the size of the package, Lisa, is so important. On stimulus in Washington to a beleaguered America, the size of the package matters, doesn't it?
Yeah, and actually, Terry Haynes of Pangea Capital came out with a note saying that he now thinks there's an 80% chance of a nearly $1 trillion plan passing before year end. Yes, it is the size, but composition matters. It goes beyond size. And I think that really the key question here is, if you do not get enhanced unemployment, will it have the same bang for the buck? Will you have the same bang for the buck if you don't get state and local government aid? And these are really important questions still to be hashed out, Tom.
Let's fold the data check in here, John Farrow. Futures up 5, Dow futures up 72. But in the bond market, it's real simple. Steve Major of HSBC, Jim Caron of Morgan Stanley, really pushing against the comments of James Dimon of JP Morgan. John, that debate just won't go away.
75 basis points is the call from HSBC. Year-end, not 2020, year-end 2021. 75 basis points is what Steve Major is looking for. We have had a long line of really smart people being made to look foolish by a bond market and yields that just refuse to go materially higher. And I've been asking a question, and many others have as well, Tom. If we get a sell-off in the bond market, a material one, 50 to 100 basis points, say, if we can call that material these days, maybe we can. How self-limiting is that sell-off? How long before yields kick higher and then equity and risk assets fall out of bed and then yields kick lower again? How long, because we've added so much debt to this economy in the last 9 months, how long before yields higher start to weigh on concerns about growth because of the debt load and then yields come back in again? The only way you see Treasury yields materially higher in the future is one of two things. Either we can generate the kind of outlook for growth and inflation that leads to higher interest rates that means yields are going to go up,
right,
materially so, in the next 5 to 10 years, one, or two, you start to question the credit of the U.S. government. And when times get bad, yields don't go lower, yields go higher.
Come on, you sound like you're on the edge of Lisa Abramowitz there.
Let me clarify. Point two,
like,
we had the stress test early this year. We had the stress test for core government
the
bond
gloom
markets.
is just killing me.
Which way did yields go? Yields didn't go high, they went lower.
You can't
Not just in the United States.
Okay, enough gloom, guys. You're
this is me
killing
in the
me
audience and you talking to each other.
I mean, this is just like the level of gloom. We got to go somewhere where there's no gloom. Joining us now, Sam Stovall, CFRA, and he does this off of the death of Robert Stovall, the giant, truly the giant of what we do. You think of Lou Rukeyser and Wall Street Week. Michael Holland knows this. Robert Stovall invented it. Sam, we are thrilled to have you with us this morning. Tell us about the optimism of Robert Stovall that you carry with you.
Well, good morning, Tom, and happy birthday to you. Yes, Pop passed last Thursday very peacefully, but he taught me, he said, Sammy, Americans are optimistic by nature. It's okay to be cautious, but you really want to question whether you want to be outright bearish. Primarily because if you are bearish and wrong, you're ridiculed. If you're bearish and right, you're hated. So it's good to be cautious because there usually are opportunities almost everywhere. And as John was just mentioning about the concern about higher interest rates, U.S. bond decline, et cetera, it means that investors are simply going to look elsewhere and probably overseas.
Sam Stovall, David Kostin at Goldman Sachs has the courage to model out optimism to 2022. Do you?
Yes, I think that when we look toward, well, I'm looking to 2021, setting us up for 2022. I do notice that when we look at the number of all-time highs that we've had this year, which is 30, above the average of 23 since the Dow got back to break even in 1954, we've also had volatility, 1% days plus. We've had 108 of them this year. That's twice the average. In the following year, whenever we've been above average in terms of volatility and in all-time highs, in these post-bear market years, the market was up 10% on average and rose in price every single time. So history is a good guide, obviously never gospel, but it's encouraging that in 2021, chances are this could be a good year as well.
Sam, we seem to have lived about 20 different outlooks in the space of 6 months, and this is by far the more constructive one. In your experience, can you think of a time where the story has changed so quickly, so often, like it has this year?
Not that quickly. This year, we actually went from peak to trough in the bear market of 34% in only 33 calendar days, which was 3 times as fast as we experienced in 1987. We then got back to break even in 5 months, the third fastest on record. So essentially, it was a situation that was pandemic in its initiation, that was human designed, if you will, to close down economies. But once the Fed said we will do whatever it takes, we knew that the fiscal policy as well as monetary policy was behind us.
So when you look at the technicals, though, Sam, there's a question of what will outperform. Yes, perhaps everything will do well and continue to do well. But Bespoke Investment Group came out yesterday and said the NASDAQ has posted a positive return on 62% of trading days in 2020. That ranks as the 4th highest going back to 1971. Typically, it will underperform the year after. Do you think that the NASDAQ is going to be a weak spot heading into 2021?
Well, we've definitely seen exuberance, over-exuberance, in my opinion. I will change that into the growth area. When you look at the rolling 12-month differential between the S&P 500 growth and the S&P 500 value index going back to their inception in the mid-1970s, we hit an all-time high, a 35 percentage point differential, which was even higher than where we were back in the late 1990s. So for me, yes, fool me once, shame on you. Fool me 3 times or 12 times, shame on me in terms of forecasting a rotation into value. I think we just got to a level of excess so much with growth that by default we have to be looking toward value this year.
Well, looking at the NASDAQ over the last 10 days, Tom, this rally's been phenomenal. It's been 10 straight days of gains on big tech, record highs, not just on a small caps, but also on the NASDAQ 100.
John, this is so important. Thank you for bringing this up. Folks, the whole idea that everything else is picking up, we heard that from Gabriela Santos of JP Morgan, is great. But, John, you've still got NASDAQ moving along, maybe not like it was before. Why don't you continue with Sam?
Well, Sam, let's talk about that. I think there are obvious lockdown winners that won't be winners when we reopen and move beyond this pandemic. And I think Clorox is the example often used, classic example. Then there are these companies that are a hybrid. They do terrifically well in the lockdown because it accelerates the secular trend. Think Amazon, think Zoom. But they're also going to do well even when we reopen. And arguably, Sam, they'll do well over a much longer time period as opposed to those companies that were trash and were fighting for survival. And now they're surviving, maybe. So, Sam, you've got the distinction there between the catch-up trade, the quick 30 to 60-day snapback because they're going to survive. But there's a difference between surviving versus thriving. So, Sam, my question, and I'll get there, forgive me, is how you draw a distinction within value between the companies that are just the catch-up, the dash to trash, and the companies that will actually do well in the same way that these secular growers will.
Well, that's a good point, because historically what we find is that in the 9 months after a bear market bottom, it's usually the 3 worst performing sectors that tend to outperform the market and the 10 worst performing sub-industries. And they've done that this time around. The 3 worst performing sectors are up 70% versus 65% for the market, and they were energy, financials, and industrials. And then the 10 worst performing sub-industries up 90% versus 65% for the market. And those are, half of them coming from the oil and gas area, but then others, department stores, airlines, hotels, et cetera. So I would tend to say that you're right. Like food retail is an area that just recently fell out of my industry momentum portfolio, a category that I think has seen the light of day, if you will, has seen its day in the sun because of the lockdown. But investors are going to be gravitating more toward areas that could have longer term potential as the economy improves. Air freight and logistics, many in the industrial category, trading companies, trucking, also looking for in the tech area. I think one reason is that the market is anticipating that interest rates will remain low. And that's why the growth companies have done so well, because when you have an interest rate below 1%, we forecast it to remain below 1% in 2021. Wow. It makes for the intrinsic value computations to be much more attractive.
Sam, appreciate your time this morning, sir. And truly, from us all here at Bloomberg, our thoughts are with the family for your loss in the past week, sir. Sam Stovall there of CFRA. For our audience worldwide this morning, good morning. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Trump administration is making its first move since Election Day to break a long standoff over a coronavirus relief package. Treasury Secretary Steven Mnuchin's plan calls for $916 billion in spending. It would include aid to the states and liability protections for business. House Speaker Nancy Pelosi called it progress, but she said it shouldn't disrupt negotiations that are already underway. And the U.S. government has an ambitious plan to vaccinate most Americans by next summer, but it rests heavily on 2 coronavirus shots that U.S. regulators won't get a chance to rule on until early next year. That's AstraZeneca and Johnson & Johnson, which together would provide up to 200 million doses of vaccine in the first quarter. The Supreme Court has dealt a sharp blow to President Trump's efforts to overturn the election results. It rejected a request by some of his allies to overturn Joe Biden's victory in Pennsylvania. The High Court's decision came in a one-sentence announcement and didn't say whether any justices dissented. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I'm not a strong believer in Bitcoin. For all the reasons it's a strong developing asset class, it may fail.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This would be one of the hardest, the most costly operational challenges in our nation's history. We need Congress to finish the bipartisan work underway now, or millions of Americans may wait months longer to get the vaccine.
President-elect Joe Biden there urging Congress to close a deal, a bipartisan deal down in Washington, D.C. For our audience worldwide this morning, good morning to you all. That'll be the topic of debate for the next 5 to 10 minutes on this program. For that matter, through the next several hours on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the shape of the price action this Wednesday morning, counting you down to the opening bell, a couple of hours away, 1 hour and 12 minutes away, with an equity market up by about 5 basis points, up about 1/10%. No drama in foreign exchange. Euro-dollar unchanged, 121.10. I'll keep this one short. Yields up by a couple of basis points to 0.94%, Tom, on a 10-year.
I'm not going to keep this short, John. Look at the real yield, and I don't mean the show on Friday. See it on Bloomberg Network worldwide. I'm sorry, out to 4 digits, the real yield's giving me a negative 0.99. John, it won't give it up.
I'm with you, Tom. I'm with you. I just wanted to keep this short so we could get to our guest and talk about stimulus. But yes, I think that has been at the epicenter of financial markets over the last year. That has been the story.
Yeah, there's no question about it. But Jonathan Lieber knows that this is the point where we always promote the real yield. Again, look for that on Bloomberg Television Friday afternoons. Jonathan Lieber with us with Eurasia Group. And, of course, looking at the United States. Jonathan, an open question. In all of this foolishness and tragedramedy about stimulus, what's the pro thing you're trying to observe?
Can they, will they or won't they, is the question that we've been asking us for 7 months now. It seems like they're on the precipice of a deal, but every time they find something like they're close to a deal, they find a new excuse to disagree. I mean, it's almost like Lucy in the football, where they get right up to the edge and then they whiff and fall on their backs. So I think we're really close here, though. Last night, the offer that Mnuchin made to Pelosi is legit. It meets all of her criteria in terms of the dollar amounts. And now they're just quibbling about the content.
Right,
and
John.
if it's a fight over UI checks or direct checks, I think that's easy to solve.
I know Lisa wants to pick it up. John, football here is American football. Lucy would hold the American football, and Charlie Brown would try to kick it just to help you with that, John.
Why would someone hold the football, though, Tom? Why would someone hold it?
It was pointy. It's a pointy football, and you had to hold it to get 3 points.
So it's not round?
Oh, my God.
It's not round.
Oh, my God.
It's more
Literally,
like...
It's not round.
It's Guy Johnson will explain. It's
holds
Edge rugby. Yes.
Quote of the day.
Someone holds the ball.
Quote of the day, I'm not going to keep this short. Tom Keene. That basically sums it up. All right, we'll get into the debate over football, round versus oblong. Jonathan Lieber, I apologize to you. This is Bloomberg Surveillance to all of those listening on radio and watching on Bloomberg Television. I'm wondering about the minutia here and whether there's more Democratic acceptance of this liability clause that the Republicans have put out. Do you think that we're going to get that in along with state and local aid?
I think they're going to have to. McConnell's been extremely forward-leaning on this issue for at least half the year now, and I don't know how he can back down. Either he needs some way to cut a deal that helps him save face, or they're going to have to give a little bit on it. The Democrats are concerned about this proposal. They say it's taking protections away from workers. The Republicans say they need it to reopen. And there's got to be some kind of compromise agreement here that at least can give both sides a big relief.
Well, John, let's talk about the potential for a compromise. The compromise is that they take their 2 red lines and they put them to one side and come to a deal, which is what Leader McConnell is trying to pursue now, or has been trying to pursue for the last several months, which is something smaller, something we can all agree on. John, have you seen any evidence whatsoever in the last week or so, the last couple of weeks through these negotiations, that Democrats and Democratic leadership are willing to put aside their demands for state aid, so long as Republicans put aside their demand for liability protections and come to some kind of deal on everything else?
No, none whatsoever. And in fact, that's why the Democrats are so eager to embrace this bipartisan gang proposal. It's because the gang proposal, they claim, has bipartisan buy-in now for doing something on state and local aid. But of course, it also includes liability. So you either have to do a deal with both or you have to do a deal with neither. There's not going to be a middle ground. The Mnuchin offer that came out last night was a deal for both. Right. And I think that's ultimately where they end up.
Jonathan Lieber, I want to go back to Tufts University, and you're one of the cool guys who got the degree in philosophy. The rest of us faked it. You actually did it. What is the philosophy of the debt is bad crew? We're at a point where liberal and conservative economists all say, get on board, provide income substitution. What is the actual American philosophy that says we can't go further, as led by the senator from Kentucky?
Well, I think a lot of it's just muscle memory at this point, where most of these members have grown up their entire careers being concerned about debt and deficits. And in their defense, the long-run picture for debt and deficits looks pretty bad in this country. You've got increasing debt as a percent of GDP going throughout the budget window. You've got the looming insolvency of Social Security and Medicare, assuming that you believe in those trust funds. If you don't think those are just accounting fictions. And long-term, it's a serious issue, and I think that's what these members are responding to. Now, in the short term, we know they're willing to do something. They all voted for the CARES Act, and I think that this new compromise bill is probably going to get 80-plus votes in the Senate once it comes together with Trump's blessing. But we're still a little bit away from that.
Jonathan, it's great to catch up. We appreciate your time and input this morning. Thank you, sir. Our best to the team at Eurasia Group. Jonathan Lieber there of Eurasia Group, Managing Director for the United States. And isn't that a story at the moment, Tom? We've got these two red lines. They've existed now all year. State aid, 1.
Yeah.
And liability protections, 2. Either there is a bill with both in or a bill with neither in. And at the moment, Democrats are looking to try and engineer some kind of bill that has state aid, but without liability protections. And Leader McConnell is trying to say, we'll agree something narrower, something smaller, without both in. I'll drop my red line if you drop yours, and we put that to one side and revisit it in January.
I've always had trouble with red lines, whether it's in Europe or here or any of the other negotiations that we dance to worldwide every day. What I suggest is there's only one red line. A lot of aid for a lot of Americans stops this week and certainly next week as well. That's the only red line that matters.
No, Tom, I'm with you. I think what puts more pressure on them, and Lisa, you've been talking to this, why the market has been rallying is the idea that the pressure is building on DC to do something that they've been reluctant to do for the last 5 months, which is drop their red lines and come to an agreement. And the pressure's coming from the pandemic. The vaccinations won't start for a while, and they won't be rolled out significantly enough to pare back on economic restrictions anytime soon. So the pressure's there. You're seeing the shutdowns right before our eyes, right across the country. Once you get to that kind of point, your red lines, they matter only so much.
Yeah, and John, that's certainly what seems to be giving some feeling of increase in a chance of stimulus efforts. I'm really struck by the debate that you guys were having about the shape of a football, and I think that that really is going to be the preeminent debate in Washington, D.C. over the next 60 days. John Farrow.
I'm pleased it got your attention. I mean, I'm happy to continue a very, very important conversation on why a game would be called football when you use your hands.
Yeah,
I don't want to offend anyone.
Oh, right.
But
I got an idea.
You don't mean to interrupt.
On this simulcast, we really need a VAR. We really need like a referee, John.
The video assistant referee. Isn't that the person in the air?
We need a VAR to
screaming at us right now.
Where's my birthday, Bloody Mary Megan? Do something.
This is Bloomberg.
big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York and London for our audience worldwide, good morning to you all, live on Bloomberg TV and radio. This is Bloomberg Surveillance. I think about this sometimes, especially over the last couple of months. If I told you this time last year what this year would look like in the economy, would you have told me where this market would be? Unreal. Up 15% on the S&P on small caps, up more than 40% on the NASDAQ 100. Coming in today, the NASDAQ 100 10-day winning streak. Will we add some weight to that? The S&P 500 advancing another 6 points, up a little more than 0.1% on the session this morning. Switch up the board, get to the bond market. Yields just haven't come along for the party in the last month in the way that some people might anticipate or expect them to do so. Why? Central bank policy, just one factor as many. Looking at yields this morning, up about a basis point or two across the curve. Curve a little bit steeper. Yields higher at the long end by 3 on 30s, on 2 on 10 years to 0.94%. How much further can we go? That's going to be down to the Federal Reserve and that meeting that takes place next week, Tom. And I think that's the big debate of the moment. With the Fed, give the green light to allow yields to go higher by not extending the average maturity of their asset purchase program. That's the story for this bond market. The story for tomorrow is the ECB. Tom, I mentioned the amount of bonds that they would be buying. The ECB expected to buy through 2021 if they expand the package in the way that many people anticipate them to do so. 70% of supply from Europe, according to Fred Ducrozet, will be bought by the ECB next year. But that's not net issuance. Net issuance, taking out the redemptions, you are looking at 150% of the issuance will be bought by the ECB. Just think about that. Get your head around it. As you start to doubt where yields are, the ECB is a huge factor.
There's no question, and get your head around it is impossible to do because this is not in the textbooks. This has really been an extraordinary 2020. George Buckley is with Nomura. We're thrilled he could join us now, their chief UK economist, but far more. George Buckley over the years with immense perspective on Europe. George, this moment speaks, as John mentions, of the oddities of bond purchases and that. And I go back 6 and 7 years to the IMF, Olivier Blanchard, and among others, the laureate Joseph Stiglitz, trying to figure out how to reflate. What Olivier Blanchard proposed, and he was criticized for it immensely at the time, is what we're trying to do now. George Buckley, how do we reflate, as Professor Blanchard tried to tell us to do?
Well, first of all, let me say happy birthday to you. And to answer that question, I think it's very difficult. The problem is that, first of all, it's very unlikely that inflation, we think, is going to end. Most of economists' forecast horizons at levels which the ECB is going to be happy with. You know, we're talking about levels which are 0.5%, maybe 1% below where they'd like inflation to be. So some sort of reflation is required. And how they go about that, this is the second tricky point, which is it's very difficult when you've maxed out most of your policies. And this is why next year's strategy review from the ECB is going to be very important, because it's going to look into some possibly new techniques and tools that they could use. It's going to see how they could make the most of their current tools, what tools work best together to try and do this. But, you know, when you're talking about, are they going to do an extra 10 basis points on interest rates? Are they going to do an extra 100 billion here or there on PEP? It just shows you how difficult it's going to be, because 10 basis points is neither here nor there. It's not really going to be the make or break, right, which pushes inflation back to target.
George, these mechanics are almost Newtonian. They're almost 19th century. Ambrose Evans Pritchard in the Telegraph yesterday with a brilliant essay showing how Germany's going one way and France is going another. We've got a surplus in Germany and somewhat controlled deficit to GDP. In France, it's a mess. Will those dynamics lead to great instability if Christine Lagarde cannot be successful?
Well, that's absolutely right. I mean, France started this crisis with a higher level of debt to GDP. Germany had much more leeway to expand its fiscal policy. So in that sense, that's certainly true. And when you look at the scale of decline in GDP in Germany relative to many other European economies, Germany weathered the storm a lot better. We didn't see as big a fall in economic output at the start. So when you're the president of the ECB trying to think about ways to support the European economy, the European economy is almost a misnomer. There are many different economies in Europe, and they're all doing very different things. That said, most of the bigger economies, after the fall and the subsequent rebound, have actually recovered to levels about the same relative to 2019 Q4 GDP to each other. So, for example, Germany, France, Italy, they showed very different declines in GDP, yet they've all bounced back to within a whisker of each other. The big difference, of course, is Spain and the UK, both of which are still very sluggish, 9 to 10% below where they were. So when you're a central bank, and especially one dealing with so many diverse economies across the euro area as the ECB, it's a real challenge.
When it comes to the ECB in Europe, and forgive me for making a broad statement, George, but an economy is often only as healthy as its banking system. Do you think the banks are getting the right policy, the right assistance that they need from monetary policy?
Yeah, I think, well, banks are in a lot better position than they were prior to the global financial crisis, which, of course, is encouraging. And what the ECB is doing in its monetary policy, as we've seen, is to help the banks as much as it can. The PEP will, and particularly the TLTROs will, and I suspect what we're going to see from the TLTROs is an extension of this cheap borrowing, and also a cheapening of that borrowing. It may be the case that they say, well, if you lend even more to the real economy, then we will give you an even better rate. The one thing they haven't done, of course, in this crisis is to lower interest rates. So we haven't seen a cut in interest rates from the minus 0.1. One of the reasons they haven't done that is they're very fearful about what impact that might have on bank profitability. Now, they can counter that by changing things like the tiering ratio. But, of course, that is certainly on their mind when they think about how to recalibrate policy this week.
George, as you've seen, though, in the lending surveys, banks are tightening their lending standards. I just wonder whether the ECB can actually do anything about that.
Yeah, it's difficult. I mean, they are everywhere. I mean, look at the UK, for example. We've seen very large increases in mortgage interest rates, and not surprising. I mean, would you want to lend at the same rate if you were concerned about getting your money back when you're lending to borrowers who may find themselves unemployed, because most estimates now for unemployment, both across the euro area and the UK, are for a notable rise over the course of the next year. So I think they've got to be very careful. They can't just simply offer the same terms and conditions as they did when unemployment wasn't expected to rise. So I think that's got to be a feature of any bank's lending. And the other point to make here is that, we often used to look at the credit impulse, and we used to say, well, when you get a big surge in the credit impulse, the change in the amount of net credit lent on, that was very good for the economy. But on this occasion, a rise in credit is really telling you about how much firms are having to borrow to see themselves through what is an exceptionally difficult time. So the fact that we're seeing some easing off of total lending to corporates might not be a bad thing.
Although you do have to wonder, if you don't have that transmission mechanism to Main Street, if you don't have that feed through to the true economy, then what's the point of accelerating quantitative easing when it's clearly is not necessarily getting to the economy in real time?
No, and this is what they are trying to do. I mean, they are trying to do a combination of both. To help the transmission to the real economy, they are providing TLTROs, the Bank of England, its TFSME program, both of which are intended to encourage banks not just to borrow money and sit on it, but to borrow money and lend it out. So that's clearly the way it's happening. But also, in terms of the asset purchase program, it's not just a case of lowering the borrowing costs for governments, because the borrowing costs for firms when they go to the market is a function of what government borrowing costs, because it's usually government borrowing plus costs plus X, whatever that X might be for different firms. So in that sense, it is helping. And also by withdrawing, as we talked about before, by withdrawing a lot of cash out of the government bond markets and buying it up if you're the central bank, it means that there is plenty of other assets which are going to be available, which will have to be bought instead. So it's this idea of moving along the risk curve, and that should be also helpful.
George, are you saying that right now quantitative easing and a negative rate policy together have been very effective and should be looked back on with history as having been appropriate for getting the Eurozone up and running and out of a negative inflationary environment?
I think it's exceptionally difficult to say exactly what central bank policy has been able to achieve, but I wouldn't like to see what it would be like if we hadn't done anything and we hadn't loosened policy in the way that policy has been loosened. I suspect that conditions would be substantially worse. I think the markets would be far more concerned. They'd be putting much larger risk premia on peripheral debt. So I think it would have looked a heck of a lot worse, and sentiment would have been worse. So I think it has had an important impact. It's important not just to look at where we are in terms of levels of GDP relative to where it was and say, oh, look, QE didn't do anything, TLTROs didn't do anything. The point is, you've got to think about what would have happened had we done nothing. And I think it would have been a lot worse.
This must be the longest conversation you've had all week, and you haven't spoken about Brexit, George. We have 2 minutes left, so I'm just going to punish you with it. Just torture our whole audience. Can you just walk us through in 60 seconds, George, what to watch in the next 24 hours through this evening?
This is amazing.
Well, I suppose we have to think about what this dinner's going to yield this evening between Mr. Johnson and Ms. von der Leyen, and whether that ends up in something positive or negative. I mean, at the moment, we really don't have any idea. And you can imagine all of these economists sitting there trying to write their 2021 outlooks and thinking, well, what assumptions do we use? Do we use the assumption that this is going to end in a no deal, a deal? Because when you look at the impact analysis that the OBR's done, the Office of Budget Responsibility, the Bank of England's done, and look at the scale, and many other studies for that matter, look at the scale and the difference of effect of what happens in Q1 next year if we get a deal versus no deal. Now, to be honest,
just assume next year's got to be better than this year, George. That's got to be the working assumption. 21's better than 20.
To be honest, I think it has to be the working assumption, because assuming you get a big COVID-related bounce, in other words, a vaccine-related bounce, then Brexit you might not even be able to see it in the data, because this is going to be such an important and momentous occasion that GDP will bounce very significantly eventually at some point in 2021.
I think we sent Tom to sleep, George. We've got to leave it there. George Buckley.
He's snoring.
Of Nomura.
He's snoring.
On Europe, and then at the end there
he goes.
On Brexit. There's the Tom cam. You see, if you're on radio, I'll run you through it. Tom's got his head down. half asleep. This is what happens sometimes when you get a little bit older.
Oh,
need a nap.
Oh my goodness. Come on. Happy birthday. Tom Keene woke up just with that.
Brexit. When's it over? Seriously, John, when is Brexit over?
Really?
Do you think I thought it was going to last 4.5 years?
No.
You know when Prime Minister David Cameron made it sound so simple? I remember him saying that if you vote to leave, I'll go to Brussels, I'll trigger Article 50, and we'll leave. And then he quit. Then we spent 4.5 years talking about it.
Let's spend 4 more.
Here we are. I haven't got an answer. I try and avoid it. Just don't have an answer. I don't think anybody does at all. And I don't think the deadlines are fixed. I think they can all move because we've seen them move so many times.
Is there a window like where I can make my first trade in the market? Is there an entry point?
I think we got to go.
Who's telling you that? We've got to leave. We've got a boss. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The UK will drop tariffs the European Union imposed on $4 billion of US goods. It's part of the long-running dispute over illegal aid to aircraft manufacturers Boeing and Airbus. The UK says it will set its own tariff policy when it completes its split from the EU at the end of the month. Some Democratic lawmakers are balking at Joe Biden's choice. And Elon Musk is tired of being taken for granted. Switching stories here. So he's moving from California to Texas. The billionaire co-founder of Tesla told the Wall Street Journal that California has become complacent with its status as an economic giant and is taking too much for granted. Tesla is headquartered in Northern California, but Musk is building a factory in Austin, Texas. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Somebody, any head of state in the world, how hard is it for you to get anybody on the phone? I assume not too hard.
I would say it's not too hard, but sometimes it takes a week.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
John, it's so good for me to be at home here.
Basically, yes.
I'm shocked. John, I'm watching TikTok right now.
You look
Hold
very
on.
distracted.
I'm
What is
looking,
that?
and when you feel really confident, put on a bow tie and go explain events on TV. Why do so many TV economists actually wear bow ties is a mystery.
You're going to be okay. You
Megan,
get through
my
this. You can
walker
do
here.
this.
I've got to walk.
You've got this.
I've got to
Come
walk
on.
over.
You've got this.
Okay, would you get my walker, please?
A very happy birthday to our good friend,
they're
our
so
partner in
evil.
TV chaos.
John Farrow's going to say.
Tom Keene. From me to you, Tom. From all of us.
Thank you.
Happy birthday, sir.
It's been great. David Rubenstein is going, why am I doing this?
He's going to show us how he puts on a
John,
bow tie.
what do you got on the show next on your other property that's more important than us?
Steve Whiting City, it's your birthday, but don't forget it. It is more important. It
I'm
comes
never
up
talking
next.
to
It's
Whiting
15
again.
minutes away.
John Farrell, thank you so much. Whiting is awfully good, particularly seriously, folks, on the linking of profit, corporate success in our American economy. Right now, David Rubenstein joins us, peer-to-peer conversations, and this conversation is important because Mr. Rubenstein speaks to the gentleman who invented conversation in the modern zeitgeist. He is Klaus Schwab of Davos, and of course, he has added so much to what I have done with his initiative to get people together to converse. They will shift from Davos to Singapore. Of course, Mr. Rubenstein speaking to Dr. Schwab before the announcement of Singapore. David Rubenstein, many people know who Klaus Schwab is. What is the distinction for those that do not know him about Dr. Schwab?
He was he's a German citizen by birth, was a professor at the University of Geneva, and 50 years ago came up with the idea of bringing people together, talk about global issues. It was about a couple hundred people in 1971. It's now thousands of people who go. It is seen as an overly elite gathering, but he has many young people. People are not yet, quote, elite, and it really does a good social purpose. I should disclose I'm on the board of the World Economic Forum, and I do think it's a good operation. It does serve useful purposes, but I recognize it has been criticized by some as overly elite. I don't really think that's fair, but that's the criticism.
David, I strongly agree with you, and everybody that knows me knows I'm a huge defender of what Klaus Schwab defended, and a lot of it, folks, is jealousy to go up Happy Valley. David and I have done panels there to great success as well. What does Davos look like in Singapore this year for Dr. Schwab?
Well, normally we are trooping around trying to dodge some of the snow and other ice kinds of things. This time we won't have that in Singapore. But I think what Klaus wanted to do is to have the first gathering, global gathering in person after the virus is sort of behind us a bit. And it wasn't possible to do it in Switzerland because of some health reasons. So Singapore seemed like a better place. So everybody will troop there. Some of it will be virtual, though. And I think they'll have a fair number of people in person, though.
It's an interesting time to be discussing the World Economic Forum and just large confabs that have traditionally been the birthplace of a lot of interesting ideas, often that are created behind closed doors, not necessarily in the discussions on stage. David, it puts a highlight on how different 2020 has been. Do you think that the experience of the pandemic has put into cold relief the importance of these in-person meetings, or do you think that it's shown how things can migrate to a virtual type of platform?
The world has changed forever, and there's no doubt that people don't want to travel quite as much, and they can do virtual meetings, and everybody realizes there's a lot more simplicity to doing it and a lot more ease. On the other hand, well, for thousands of years, humans have liked human contact, and I do think that that will revert to the mean, and that therefore you will have more people gathering in person, but there will be a hybrid. Some people will come in person, some will do it virtually, and that's probably what the norm is going to be in the future.
So sort of merging some of these ideas here, David, you're talking about the criticism that the World Economic Forum has had as being elitist. Do you think that this new virtual era will democratize the concept of some of these large meetings by bringing more people in and allowing them to join, if not perhaps by private jet, virtually?
Sure. People who can't afford to go to Davos or Singapore will be able to do it virtually with virtually no cost. And so I think that will help. And I think it'll also attract younger people who may not be able to afford to go to places like Davos from time to time. So I think it will be helpful. Yes, I do think so. And I think Klaus has been a genius at putting it all together. You know, think about this. How many things are still working pretty well 50 years after they were invented?
David, what this is about is capitalism and the arch reality that Dr. Schwab has noted, and I'm sure David Rubenstein has noted. We're not clearing markets like we used to years ago. The zombiness that is out there is tangible. When are we going to start clearing markets so we can get back to financial normality?
Well, I don't know, because obviously there's a lot of frothiness in the markets right now, and I suspect at some point some of that will come down and deflate a bit. There's no doubt that the world has changed, and people are looking at different kinds of companies, and people see it as a land rush. They want to be on the ground floor of the next Zoom in technology. And I think a lot of people feel the world has changed, and if you're not on the ground floor, you're going to miss out on great profits. That's why the frothiness is there. Some of these bets will be great, some won't be great.
David Rubenstein, thank you so much. Of course, with Carlisle, and of course, look for Peer-to-Peer with Klaus Schwab, 9 p.m. On Wednesday. Looking forward to that, to say the least. With Klaus Schwab of the World Economic Forum. Excuse me there, I was losing my train of thought. This is incredibly important. Somebody in the household came up to me and said, there's a whale in New York Harbor and up Hudson River, and you need to be courageous to do this. This is Lisa Abramowitz in a canoe last night. She took the canoe that she had up in the Adirondacks, and she's out there in Hudson River looking at a humpback whale. Lisa, this is a rare occurrence, to say the least. Nice video.
How did you track me, Tom Keene? How did you know I was out there?
One of the offspring brought it in.
Oh, yeah, is that right? So this was your birthday discussion, your pre-birthday discussion, Tom Keene, of the whale. Can I just say, you've been speaking about a whale all morning, and I'm thinking, are you talking about SoftBank going private? Are you talking about the Federal Reserve buying treasuries? No, you are talking about a humpback whale.
This is very, very cool. And I looked it up for the River Thames. And for those of you in England, it's an even more rare occurrence in England. Really back to 1913. I think it's only happened once as well. But this made headlines here in New York City yesterday. For those of you on radio, what you need to know on radio is basically Lisa's out in her canoe just getting ready for the next trip to the Adirondacks. And it's like the Loch Ness Monster is what it looked like. I mean,
me or the whale, Tom Keene?
No, I said the whale. Please excuse me. So let's look at the market.
Let's look at those markets.
Lisa, the market will save us always. Lisa, this is a market that will not go down, isn't it?
No, record highs. And I got to say, I was reading some of the outlooks for 2021 overnight, because that's what I do in the evenings. And there was this clear theme that the fundamentals do not justify the enthusiasm you're seeing in equities, but policy is coming in and propping up valuations and will continue to do so, so buy. That is the thesis right now on Wall Street, carrying through again to today.
Yeah, no question about that, and we'll be following this through the day on Bloomberg Television, on Bloomberg Radio. Speaking of radio, Al from New Jersey, thank you so much for emailing in to describe the Abramowitz video of the whale. Again, the sunset, the Hudson
Happy
River,
birthday, Tom.
Light waves, and for those of you on radio, think Nessie and the Loch Ness Monster.
I'll give you a canoe.
I can't.
Your very own canoe.
If I'm in a Kevlar canoe, I go right through the Kevlar to the bottom of the sea. Jay Clayton, Bloomberg Television, not radio, Jay Clayton, SEC chairman with David Weston. This is Bloomberg. Stay with us. Futures up 7.
once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now. We're 30 minutes away from the opening bell. We had some weight to record highs. On the S&P up about 6 points. We advanced 0.2%, and we begin with the big issue. The White House returning to fiscal talks for the first time since the election. Treasury Secretary Steven Mnuchin pitching Democrats a fresh $916 billion package, including money for state and local governments and robust liability protections for businesses, schools, and universities as well. Speaker Pelosi and Senate Minority Leader Chuck Schumer calling it progress, but preferring to concentrate on the bipartisan negotiations already underway. Senate Majority Leader Mitch McConnell suggesting he'll set aside his top priority of business liability protections in exchange for Democrats dropping their demands for state aid.
What I recommend is we set aside liability and set aside state and local and pass those things that we can agree on, knowing full well we'll be back at this after the first of the year.
All of this coming amid surging virus cases and signs of slowing economic growth. President-elect Joe Biden pledging to change the course of the pandemic in his first 100 days.
This will be one of the hardest and most costly operational challenges in our nation's history. We need Congress to finish the bipartisan work underway now, where millions of Americans may wait months longer to get the vaccine.
Joining us now, the Bloomberg team, Kevin Cirilli and Abigail Doolittle. Kevin, let's start with you, sir. We've been going back and forth on this. Where's the progress? I hear lots of noise, see lots of movement. Have we made some progress?
Yes, there is significant movement, especially as Senate Majority Leader Mitch McConnell backing off his demands for there to be liability protections in a final fiscal stimulus package. This is Speaker Pelosi trying to, behind the scenes, orchestrate Democrats and enough Democrats that she would be able to deliver even without the allocations to states and local governments in terms of the funding that they have been seeking. That bargaining power is really what will ultimately decide whether or not there is a deal, I'm told, in the next 7 to 10 10 days. Now, Treasury Secretary Mnuchin's advancement of this and entering back into these discussions is being interpreted by my sources on both sides of the aisle as an effort, as a solid effort rather, and a clear sign that things are moving in the right direction. We'll be watching for is whether or not the optimism continues around the omnibus and the government funding issue. If that optimism is to be depleted, it would suggest that there would be a significant hurdle for fiscal stimulus talks. But right now, I don't want to get ahead of anyone, right now, that doesn't appear to be the case.
Well, right now for this market, Abigail, the read across is pretty clear, except I think a lot of people are just basing how they think talks are going on how the market closed the day before. If the market is up, people will say talks are progressing, they're going well. If the market's down, people will say they're not. This market's just in its own world, isn't it, Abigail?
It is very much in its own world, seeming to ignore a lot of the real world uncertainty. And it's interesting, John, here on this news around the White House being back in on talks around stimulus and the idea that a deal could get done by the end of the year, I would say we're looking at a modestly risk-on tone, but it's almost a bit of a yawn. Very small moves for the S&P 500 futures, up just ever so slightly. We have the stock 600 up a bit more, so clearly affecting global stocks in a positive way. Bonds off a little bit, but not a huge sell-off, still very much in this year's range for the 10-year yield, the more positive reflation part of that range. And then the VIX down ever so slightly. Investors telling us we've been here before. We want to actually see the deal signed. As for the global all-world indexes, though, John, another record high. So to your point, we do have this surreal risk-on flavor. Once again, stocks around the world climbing, perhaps damping the overall risk-on tone, though, John. As you know, Brexit talks really stalling. We have Boris Johnson saying no leader could accept the deal that's been proposed right now. If we go into the Bloomberg terminal, we will see one way of hedging against the pound. It is spiking sharply higher, suggesting some folks are uncertain and nervous there, John.
Abigail, slipping in Brexit on this programme, 25 minutes away from the opening bell. We'll do our best to avoid that if we can through the rest of this hour. On the stimulus negotiations, JP Morgan's David Kelly expecting lawmakers to pass another bill, but encouraging Congress to spend it elsewhere. He writes the following: the economy does not need another broad round of stimulus checks. Investors should hope for a package that supports those impacted by the pandemic, rather than one that blindly pumps money into an injured economy. David joins us now for more. So, David, walk me through this just quickly. The optimal composition of this plan, what do you think it is?
Well, I think, first of all, you need to have those extended unemployment benefits. There are large bunches of people in this economy who cannot go back to work. If you look at the labor force is down by 4 million people since February, and that's unique in recessions. The labor force normally goes up 9 months after a recession. So there are a lot of people who just can't get back to work. They need support. They need at least that extra $300 in enhanced unemployment benefits. They need extended unemployment benefits. We also need state and local government money. We've seen 1.3 million state and local workers lose their jobs since the start of this recession. We've got to get money there. What we don't need is stimulus checks for people, regardless of whether they've actually been impacted by the pandemic or not. That's crazy. We don't have the extra money. Frankly, there's nothing useful that people can do with a lot of this money if they have a job, if they're getting an income. I mean, of course, everybody wants another check, but that's not the important thing. The important thing is to support those parts of the economy that are truly injured, support state and local governments in distributing vaccines and in helping put an end to the pandemic. That's really what the government needs to do here, rather than just pour money at the problem.
Well, we'll go through the latest aid package on the table in just a moment. I want to get to some breaking news just quickly and cross over to Bloomberg's Abigail Dillittle. Hey, Abigail.
Hi there, John. Well, Starbucks has named Melody Hobson as a non-executive chairman of the board. She is replacing Myron Ullman III. The shares of Starbucks not reacting all that much on this news. But again, Starbucks has announced the appointment of Melody Hobson as non-executive chairman of the board.
Abigail, thank you. The latest news on Starbucks, we'll recap that in around about 4 or 5 minutes' time. Let's turn back to David Kelly now of JP Morgan Asset Management. David, just to go back to what you said there about the package from Washington, D.C., the bipartisan offer that Mnuchin is trying to push now contains checks but does not contain the extra benefits that you would get for being unemployed. So if that deal passed, all $916 billion of it, and it doesn't look like it will, but if it did, David, would that change your outlook in any way, shape or form?
It wouldn't really change my market outlook that much. I mean, the economy is going to bounce back when this pandemic is over. but it really does change the human outlook for everybody over this winter. I mean, what are you supposed to do with a $600 check, one $600 check to get through the winter if you're unemployed and if you've got no way of getting a job? I mean, it doesn't help those people who are being hurt the most. I think that's I appreciate that the administration is making an offer. I think there are a lot of offers on the table here. Hopefully we come up with something sensible to tide people over until we get to January or February, and then we've got a new Congress, and perhaps we can, the political temperature can come down a bit, and we can try and come up with something more durable to get past the rest of the pandemic. But as I said, what we need is to support. The economy is not tired in need of stimulus; it is injured and in need of support, and that's really the whole point here. You've got to help those people that are really hurting here.
David, it's the difference between aid, I think, which is the right word to be using here, and not stimulus, which you and I have talked about before, and I've talked about a lot on this programme. Capital allocation decisions through 21, David, we've all read the same outlooks. They're all the same. Equities, risk appetite, elevated, underweight bonds, overweight international. Is there anything different for you, David? Do you set yourself out from the pack? Do you feel the need to? Or is the crowd ultimately the right place to be with?
Well, I think that the crowd's probably, it is right in the long run. I would say that value over growth in the U.S. in the long run, and also just beware of mega cap stocks. There's a huge difference in valuations between the top 10 stocks in the S&P 500 and everything else. And then, tamp down your expectations here. I mean, if you started these levels of valuation in the S&P 500, the returns over the next 5 years are not going to be strong. So you really, you can't just autopilot this one. You've really got to look carefully at where there really is value in markets. And I think as uncertainty diminishes, momentum trades will also diminish. I think it'll be more about valuations, and there are good values in markets. They're just not in large cap growth stocks or in long duration safe bonds.
Do you like the 10-year Treasury here, David, in any way, shape, or form?
No, it's crazy. I mean, it is a negative real rate. I give the government money for 10 years. They give me less purchasing power back at the end of that period. That makes no sense at all. And I do think the rates will rise as the economy recovers.
I had a feeling you'd be on the same page as a certain Jamie Dimon, who made the comment yesterday that he wouldn't touch treasuries with a 10-foot pole. David, your thoughts on how high yields can go and how self-limiting any potential sell-off would be?
Well, I think we could get back into at least positive real yields on, say, 10-year bonds. So if the underlying inflation rate's 2%, then we get to, I think that by the end of next year, going into 2022, we could hit that 2% mark or go higher than that. I think there is a limit, because this is a very disinflationary global economy naturally. So we're going to get this surge in growth and maybe a surge in inflation later next year. And then I think things are going to calm down again in 2022. And as that happens, I expect that rates will remain low. So traditionally, if you look historically, the real yield on a 10-year treasury is about 2.5%. Now that would mean a 4.5% yield. I don't think we're going to get there, but I do think that we're going to go to 2% by early 2022, and maybe move up a little bit from there in the years that follow.
David, great to catch up, as always. My best to you and yours, and my best for the holidays as well, sir. Thanks for everything this year. David Kelly there of JP Morgan Asset Management. In this market right now, futures up about 6 points on the S&P 500. To recap some of the news in the last 5 minutes and get you some of the movers as well, here's Abigail.
John, well, let's take a look at that breaking news, Starbucks, that we had just moments ago, with Starbucks naming Melody Hobson chair of the board. She is a non-executive, meaning that she's not on the management team. She is a co-CEO of Ariel Investments, and she was reportedly on the short list for Treasury Secretary, losing out to Janet Yellen. She is now chair of the board for Starbucks. As for some movers on the morning, it always comes back to the vaccine companies, or at least recently, John. Let's take a look at both Moderna and Pfizer. These stocks popping higher once again. The next FDA meeting on Pfizer is tomorrow, and of course, their vaccine has begun a rollout in the UK, while Moderna, Morgan Stanley is saying that this company can make up the U.S. Pfizer vaccine shortfall. So we see that these stocks continuing to go higher. And on this, we have, once again, the travel stocks. Yesterday, not initially rallying, but as the day went on, all stocks rallied, but particularly the travel stocks, as folks anticipate Americans getting back on planes and cruise lines soon, John.
Abigail, thank you. More from Abigail a little bit later in the hour. Coming up on this program, President-elect Joe Biden laying out his strategy for taking on the pandemic in his first 100 days. That conversation up next with BTIG's Julian Emmanuel. From New York and London this morning, good morning. 20 minutes out from the open and bow futures, just about positive. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It is still at a much too high a level. I mean, it is, as the heads of hospitals have told me, it's unsustainable at this level.
We've gone through a really tough stretch here over the last few weeks. And unless there is some evidence that that is going to change rapidly, unfortunately, restrictions are needed to protect us all. You're going to see these restrictions in a matter of days.
State and local officials continuing to sound the alarm, warning of further restrictions with new infections spreading across the country. President-elect Joe Biden urging patience, seeing better days on the horizon.
My first 100 days won't end the COVID-19 virus. I can't promise that. But we did not get into this mess quickly. We're not going to get out of it quickly. It's going to take some time. But I'm absolutely convinced that in 100 days we can change the course of the disease and change life in America for the better.
President-elect Biden laying out his strategy for attacking the pandemic once in office, reiterating plans to issue a mask mandate, increasing in-school attendance, and vowing to get 100 million doses of the vaccine distributed to Americans in his first 100 days. Bloomberg's Kaylee Lyons joins us now with the latest. Hey, Kaylee.
Hey, John. Well, let's focus first on that last part of Biden's plan, the distribution of the vaccine or vaccines, one of them likely to be Pfizer's candidate, which could get emergency use authorization from the FDA as soon as tomorrow. Regulators indicating in a report yesterday that approval was likely. It's already in use in the UK, and now there are some warnings about allergy side effects. The question is, does that weigh on sentiment, make people more resistant to get the inoculation? Pfizer, though, not the only option. The U.S. also has a contract for 100 million shots of Moderna's similar messenger RNA vaccine candidate. That could get approval as soon as this month. And there's shots in the works for J&J and AstraZeneca as well. Those two critical for the U.S. government's plan to get most Americans vaccinated by next summer, but those won't get a chance at regulatory approval until early 2021. And of course, John, the vaccines are a long-term solution to a right now problem. Cases continuing to rage Here in the U.S., currently more than 15 million confirmed cases of COVID-19 here, and as of earlier this week, the country is averaging about as many deaths per day from COVID-19 as it was back in April. Hospitalizations, as we're looking at here, just off the peak hit just days ago, but they're rising in several large states, including New York, California, and Pennsylvania. And while the hospitalization rate is starting to climb in the Midwest, many of the deaths reported over the last week are still coming from that region. So that could be a warning sign of what's to come for those coastal states, John.
Kelly Lyons, thank you very much. BTIG's Julian Emmanuel remaining bullish, with the markets continuing to look past the headwinds stemming from the pandemic. He writes the following: we want to remain invested as we see 21 as a positive year for stocks. Nowhere is this truer than the value trade, which we think continues to outperform growth in 21. Julian joins us now for more. Julian, you put out a recent note, and I thought it was really interesting. The near-term concern versus the medium-term constructive nature of your outlook. Can we just start with the former and not the latter? What are your thoughts now, Julian, on how far we're pushing this?
Well, look, if you look at valuations, and you know, your last guest and probably guests the last several days have pointed this out, is that, you know, you're pushing on valuations that are near the all-time highs. And we would also add that when the index changes on the 18th, and the largest electric vehicle maker gets added to the index, those will be valuation highs really right in line with 2000. You're pricing in a lot of good news, you know, looking 9 to 12 months ahead, but the crisis is clearly in front of us, and I don't think the market appreciates the potential for an economic downturn, perhaps only short-lived, like we saw in the second quarter, but strong nonetheless, which is clearly a headwind for not just stocks, but obviously the economy at large.
Julian, this line from you really jumped out to me. This market seems almost supernaturally able to look through the here and now pandemic challenges of the next 9 to 12 weeks as the virus acceleration poses the risk of an economic contraction in the first quarter of 21, given the restrictions we've already seen. Julian, this narrative just seems to be dictated by price. And that's something I want to sit on with you. You know, we often take the price for market, and it shapes our view on everything going on around us. So